I started thinking that perhaps my school didn't do a good job, and so maybe I was just feeling that I was good when I wasn't. But it was eventually after I started thinking about it, after I started reflecting on it, I realized that a fundamental mistake I was making at that point was that I wasn't really thinking, I wasn't really applying the the thinking or the process that that particular professional exam required. Now, from a for so most of us we've gone through universities, polytechnic, and you will notice quickly that a lot of the content taught are theoretical in nature, definitions, listing, descriptions. But for most professional exams, the idea is for you to be able to apply. Therefore, you will see questions set up in scenarios. You will see questions like the CFA questions set up in scenario with people's name, with numbers, and they expect you to think that way. They try to recreate the real world, and they expect you to apply the knowledge you have in that area into that real world situation. And that is what the CFA expects as well. So, for you not to struggle, you need to begin to rethink or look at the same subject, but in a different light. You need to begin to look at it from the thinking of the CFA, of the CFA Institute. Because if you don't do that, you might be very good in that course, maybe back in uni, but you find yourself struggling with it. With it. You will find courses like economics, like financial management, like accounting. A lot of us are already familiar with these subjects and courses, but you might still find yourself getting into the CFA program and you're struggling. A major reason why that do happen is because there is a need for you to change the way or to reimagine what is required from you from the CFE Institute, right? And so this prerequisite reading, in a way, covered that. The last thing I would speak to, in terms of the prerequisite reading, really is, so when you get into when you start studying the curriculum proper, you will realize that a lot of the a lot of the concepts discussed in the prerequisite reading are are foundational. They are foundational to a lot of the things that we're going to be talking about. In fact, for quantitative method on its own, it's not really a specialized area. It's actually a study of tools. It's a study of the tools used in other in other subjects. Now, take economics for example. If you're working on an economic problem, say population, you will need to find a way to make sense of the population data. And a way to do that is that you have to conduct samples. For example, they will tell you that the population of Nigeria is 1.80 million. Clearly, it's not it's not 180 million. I mean, it's not possible that it's exactly 180 million. But if you go out there and you quote 180 million, nobody's going to argue with you. Why? Because 180 million is an accepted estimate of what the population of Nigeria is. Well, as at the last census, anyway, which is over 10 years ago. Now, what that means is that the process for you to arrive at the 180 million, we believe is scientific enough, and we think it is close to the actual number enough that we can actually accept it as the real number. And so, what that means is that at best, that 180 million is a sample. It's not the actual population of Nigeria, but it is accepted as the population of Nigeria. Now, why is that sample accepted? The reason why it's accepted, all of that is discussed on that quantitative method to say, how do we make sense of a population when we cannot, for example, observe the whole population? For you to get the exact number of Nigerians, it means you have to go to every nook and cranny of this country and count the number of human beings that are of Nigerian descent there. That is impractical. But we could conduct census that can give us a fair idea of that number, and then we can conduct estimates and conduct samples to arrive at a number that we're comfortable with, and we'll use that number. So when you look at major data platforms today and you say what's the population of Nigeria, they're likely to throw out 180 million or 200 million, and we all use that number in your economic analysis in your role. You use that number, and if you use that number, your line manager or whoever you're presenting that data to will not start questioning you that, are you sure it's 200 million? That's because we have gone through a scientific method, a method that is logical, that has a scientific basis to arrive at that number, and therefore is acceptable. Now, where we study all of that is in quantitative methods. And so what you will realize is that the tools you will be using in economics, the tools you'll be using in accounting, tools you'll be using in portfolio management, fixed income, equities, you're actually going to be learning them in quantitative methods. And that's why quantitative methods is important. Now, imagine an engineer. An engineer could be called to solve so many problems, maybe a plumbing problem, a wiring problem, or or any types of problem. But when they're approaching a particular problem, they must use the right tool to solving that problem. They must apply the right tool, right? Now, when they get to a problem, maybe perhaps a plumbing problem, they might decide to say, you know what we need right now, it's a saw, or what we need right now is the hammer, or what we need right now is a screwdriver or a plier, right? Now they will then apply that. But first, they must understand how to use a plier. They must understand the situation in which using a plier is the best, so that when you then confront that situation in your plumbing problem, you then know that, okay, what I need to use is the plumber, but is the plier. But of course, you must have learned how to use a plier properly. QM gives you the tools to understand why you need to use a plier, why the plier is the most appropriate tool to use, and how to actually use the plier in that scenario. So in your CFA journey, not just in level 1, level 2, level 3, you realize that a lot of the tools that we talk about that you learned in level 1 will become much more useful and continue to be useful throughout your CFA journey. And not just in your CFA journey alone, even when you then go back to your place of work, you still find out that you still continue to use those tools. So it's important that that we take it and we look at it from that point of view. The way I will approach this course is really to just give you an overview and also point you in the directions where of areas where you should perhaps where the pitfalls might be, and perhaps also then drill down a bit into understanding what those pitfalls could be, and then how to navigate when you see those pitfalls. Now, the CFA curriculum is designed in 3 stages, and each of the stages according to the levels: level 1, level 2, and level 3. And this is very key. Level 1, the focus of level 1 is understanding of concepts, understanding of the key concepts. So you will realize that in your study of level 1, they want you to be able to understand specific concepts, the relationship of that concept to other concepts, how they behave in certain situations, how they behave in relation to other concepts. That is the main focus of level 1. Level 2 is focused on tools. Level 2 is where you do a whole lot of the heavy lifting when it comes to calculation, because you must then be able to display or show that you understand how to how of the tools that you're using. So the focus of level is tools. The focus of level 3 is application. In fact, in level 3, you will be given everything, you'll be given all the data. They will tell you Mr. A, they will tell you the return of Mr. A, and everything that you would typically think that you want to calculate. They can give it to you, but then they will then tell you to apply it. And what they will be looking at for is how you can apply the tools correctly to making decision for Mr. A. Therefore, what the CFA Institute out for level 1, level 2, and level 3 are quite different. Even though you will be looking at the same courses, the same subjects, the same topics, similar topics, right? And but what they are looking at for, it's actually very, very different. For example, you could see a calculation question, a number problem in level 1, and your answer might not require you to calculate anything. Yes, it will be set up as a calculation. You will see all of the numbers, but the real answer may not require calculation at all. By looking at the numbers, you should be able to tell the relationship. You should be able to tell the characteristics and the behavior, and that is what is required, and that is what your answer would be. So essentially, this just laying the foundation in terms of what is required and why I think that this prerequisite reading it's important. And I should also add that it will be important for you to focus first and foremost on the prerequisite reading, especially if you do not have background, perhaps in economics or in business. Over time, you'll find out that guys from the science background also tend to do very well in the CFA curriculum. And that is because a lot of what we're going to be teaching is about thinking, logical thinking. It's not so much about the numbers. You'll get close to the number in level 2, level 3, but how to think logically, it's a critical requirement in the CFA curriculum, and that is also required in level 1. And so, if you do not have business background, I would I would recommend that you take this prerequisite reading very, very seriously. Even though you have business background, especially economics, because the closest subject to quantitative method is actually economics. If you do not have a solid background in economics, econometrics, I would also suggest that you take this very seriously. But even if you do, it will still be important for you to see whatever differences and add-on that you might have in the CFA curriculum compared to all the other concepts that you've learned. But again, they are simple. They are if you just follow it and let it just build, you would find a lot of benefit going through this prerequisite reading. And so let's get into it. Now, the way I prefer to facilitate is really to use the curriculum. And for me, you would eventually have to read the curriculum anyway. And for me, the curriculum is the best material to use. There might be other materials by third party guys, and I'm not saying they are not good, but I'm saying that remember that the CFA Institute will not look at those materials. They will only look at their material. Most times when they set questions, they can direct you directly to where it is in their material. Therefore, I think it's important that you prioritize the material over other materials. I mean, I also understand that you might find other materials easier to comprehend, uh, or easier to read or easier to follow than the curriculum. But I will still suggest that you do not entirely just put aside the curriculum. Secondly, is when we go through the material, it also saves you time when you're reading it again, because you now know that, oh, I've covered this area, I've not covered this area, and you can take it from, and it's easier for you to track and easier for you to complete your reading the curriculum that way. However, for this morning, I'm going to split between the two. I have a bit of I've been able to call some stuff just into notes. I'll call it notes. They are not necessarily presentation slide per se, but they are notes. But what you realize is that they're verbatim from your material. All the examples, everything are copied from your material. So because that's what I like to use. Um, and I think it's simple enough if you follow it that way. And so I'll just share my screen. At some point, I will switch back. For some of the topics, we'll just use the material directly. But for this initial stage, let me switch back to, let me share my screen and just share just share with you. Just give me a moment. Please let me know when you can see my screen.
Yes, I can see your screen, Mr. Williams.
All right. Thank you. All right. Like I said earlier, take this as notes. Really, it's for me it helps to just summarize and helps to explain. But like I said, everything it's from your curriculum. If you have your curriculum right in front of you right now, you follow it, you will see a lot of this stuff verbatim. Now, the very first area in the prerequisite reading is time value of money. The time value of money is a foundational concept. It's foundational concept in finance, in investment. In fact, it's foundational. It's a foundational concept in CFA because virtually everything we do is based on the concept of the time value of money. Now, if you work in the financial services, either PE, asset management bank, investment banking, a very a critical area is return. And really, what is return? The return is a question of or an offshoot of time value of money because it is what helps us to it's equate to cash flows because it's all about cash flow. And the main question here is to say, if I have 100,000 now, $100 now, if you give me $100 now and you give me $100 later, is it the same thing? Can I say that this $100 that you're giving me now is the same? Now the note is the same, the currency is the same, right? But can we really say it's the same? So time value of money deals with the equivalent relationship between cash flows with different dates. As long as I'm not getting the cash flows today, then there is something going on. And the way to think about it is to say that there is an opportunity cost implicit in that transaction. If someone comes to me today and say, should I give you this $100 now or give you the $100 in a year's time? I might look at it to say, oh, after all, you're giving me $100. It really doesn't matter. But when you look at it critically, there is an implicit opportunity cost that is built into it. And you can even extend that question further to say, should I give you $100 now or $105 later? And we are still saying that no, it is not only that it is not that it is not equivalent, but my $100 today might still be worth much more than 105 tomorrow. So even though we are looking at the same cash flow, we are saying that they are not equal as long as the dates are different. Even if we are looking at different cash flows and one is higher than the other, it still doesn't mean that they are equivalent or that they um, sufficiently um, um, cover for me giving you the opportunity to not give me the money today and give me in a year's time. And so that brings us to what I call Mr. R. What is Mr. R? Mr. R is the return, rate of return. The rate of return is that number, that magic number, that helps us to achieve that equivalence. Now, so the key question is $100 today is not equal to $100 more in a year's time. So what would help us to equate these two cash flows? That magic number is called Mr. R, or return. And the reason for that, you can observe this very easily. If you go to the bank and you say, I want to do fixed deposits, they will give you a rate. If you put your money in a bank account, savings account, or current account, they probably will give you a rate. If you do an investment, they will give you a rate of return. Why is that rate of return important? Why is it an important topic? It is because it is what equates cash flows in the world of finance. And what is the makeup of this R? R, or return, is the single period interest rate for a completely risk-free security if no inflation were expected, right? And in economic theory, it reflects the time preference of individuals for current versus future reconsumption. What we're saying here is that if you give me the $100 now, or give me that $100 in a year's time, what I'm really my decision really is consumption decision. Should I consume this money now, or should I wait to 1 year time to consume it? Therefore, the risk-free real rate of return is that rate that reflects the time preference. That is, that reflects my preference for future or present. And that is the risk-free rate of return. And so the risk-free rate of return is a single period rate. It's completely risk-free. Now, in right now, you talk about risk-free, and you say treasuries, you say government securities, and all of that. Now, these have implication. That is, being risk-free has implication. Saying that there are no expected inflation has implication. And all of these theoretically must hold. All of this theoretically must be true. Because if it is not completely risk-free, then there has to be some premium paid for risk. If it's not completely inflation free, then there has to be some premium paid for inflation. If it is not for a single period, there has to be a premium paid for maturity. All of that must be built into R. So, but the very foundation of R, or that rate of return, is is to reflect time preference. We talked about inflation earlier, just to say that if there is an expectation of inflation, then an inflation premium compensates for that expected inflation over a period of time. We also talk about being risk-free. And how do we, why do we say that the US Treasury, for example, is risk-free? Now, one is that it can be traded in large quantities, which means there is a large pool of that instrument in issue that you can trade it in large quantities with at very minimal cost. And that is how we measure liquidity. So when we say that an instrument is liquid, it means you can trade large volumes at minimal transaction cost. And when we say it is default free, it means that it is for US Treasury, it is backed by the full faith and credit of the US government. However, when we say default free is always in relation to the credit risk. Now, US used to be triple A because of some of the issues they have been having with their debt ceiling. They were downgraded by one of the rating agencies to double A, right? But if you cannot say default free, for example, and look at another country, maybe that is already at credit rating C, and say that is default free, because that is already very close to default. So when we're saying default free, you're saying default free that is backed by the full faith of credit of a government that already has very high credit rating, maybe triple A rating or double A rating, like the US Treasury. Default risk compensates investor for the possibility that the borrower will fail to make payment, and that's what default risk compensates for. Liquidity premium, that is loss on investment relative to the investment fair value. Yeah, I mentioned earlier, if you have an asset that is worth 100 million, right? If you have sufficient time to put that asset in the market, you might get your value of 100 million back. But if you need cash very quickly from that asset, you might be forced to actually sell that asset at lower than the value. For example, if you take your car, let's say your Range Rover, to a friend and say, oh, I need money, so I want to sell this car, and I need that money immediately. Your friend would give you a ridiculous amount. And I mean, your friend will give you a ridiculous amount for that Range Rover. Your friend would know that the Range Rover is worth 200 million, but they will still price you at 60 million. But if you take that Range Rover to a car dealer and give them sufficient time to sell it off, they might be able to recoup your 200 million. So liquidity premium, therefore, is the risk of loss relative to an investment fair value, just because you need to convert to cash quickly. And so many bonds of small issuers that trade infrequently typically have high liquidity premium. What that means is that the total number of issue is small, so it's not so large out there, and they don't also trade frequently. Such asset or such instrument is likely to have some form of liquidity premium. We have maturity premium as well, which really compensates investor for extended maturity, because the longer you have to wait into the future to get that cash flow, the more uncertainty I have to face, right? And that holds true for any financial instrument, and therefore there has to be some compensation for risk. Uh, let's just look at this example. We're not going to be solving it, just for explanation purpose. There are 5 investments stated here: investment 1, 2, 3 to 5. The maturity period for each is already stated, and you can see the liquidity, the liquidity. How liquid is this? Is it highly liquid or low liquidity? Then the default risk, is it low default risk or high default risk? What you will notice from here, and what I just want to bring out, is when you look at investment 1 compared to investment 5, investment 1 has 2 years to maturity. That is, the maturity period is short. It has high liquidity and it has low default risk. Therefore, the interest rate on it is 2%. Now compare that to investment 5 that has a longer time to maturity, 8 years. It has low liquidity, which means it trades infrequently, and also has high default risk. You can see that the interest rate is 6.5. The reason why the interest rate of 6.5 is because there is a liquidity premium built in now. There is maturity premium built in now. There is default risk premium now built in. And because of the addition of all those premiums, it has moved the interest rate, that is the compensation, from 2% to 6%. And here's just a question, just to get us thinking and probably put a frame what we've been talking about. Which of the following risk premium is most relevant in explaining the difference in US yield between 30-year bonds issued by the US Treasury and 30-year bond issued by a small private issuer? Now look at it. It says US Treasury issued by government, right? And then the one issued by a small private issuer. I've highlighted the small private issuer. The reason why, when you look at CFA questions, right, also just giving you keys in terms of how to approach questions, there's always some key that is always put into the question. So when you read the question, you will find keys. Those keys are the pointer to what the answers should be. So look, when you read when you read questions, try to look out for keys. In this question, for example, I've highlighted the key. Now, when you focus on the key, the answer becomes much more apparent. In this case, we're saying that both bonds are they're 30-year, right? So most likely it is not maturity, because both already have long maturity, right? When we say US Treasury versus private issuer, both of them are already going to be exposed to the same inflation for the time period, because we're then looking for at inflation at the same time frame. But when we look at liquidity, that is where we're likely to see some difference. Why? US Treasury are typically, there's always large volume, and that it's in the market that you can trade, compared to a small private issuer, which means they will have low volume. And low volume
Um,
means low
Sorry,
liquidity.
Mr. Williams. Sorry, please, can you hear me?
Oh, yes, I can hear you.
We can only see the first, your first slide since morning, like it's not moving. It's
Wow.
not moving yet. Yes, exactly.
Okay, let me reshare. I've actually moved up to slide 9. Let me just reshare. Apologies for that.
Okay, we can see it now. We are nice. We can see it now.
Okay, so you can see it
Okay.
now. Are you saying you can
Yes.
see it now?
No, I think it's
Yes.
better
Yes.
if it's on presentation mode so that it can be moving.
Yeah, it was on presentation mode. Okay, let me put it on presentation mode and see what you can still see. Can you still see it?
Yes, sir.
Okay, and it's on
But
presentation
it's not
mode.
moving.
No, no, yeah. Is it moving now?
No, and it's not showing that it is on presentation mode.
Let me just reshare. Let me reshare. Please, okay. I can also see some hands up. While I'm trying to put it back up, let me take your questions. If it's a question, while I try to put it back on the while I try to share my screen again. Timothy, you have your hand up. Please go ahead.
Yeah, I was about saying the same thing because it was not being displayed. So some of the things we are discussing, I'm not able to relate well with them. But now that we have the
Oh,
display, I don't know whether you could please go over at the question and take them as well as find the solution again. Thank you, sir.
all right. Very well. So let me just try and see if I can resolve the issue. Let me reshare my screen again, and then let's see. Please tell me what you can see. What can you see now?
A table, sir. A practice with a table.
Good. Then is it moving?
Not yet.
Are you saying it's not moving?
Yes, it is not.
Not moving, sir.
It's not moving. Okay, hold on. Let me try something else. Okay. So what I'm doing now is that I'm sharing the entire screen. So what can you see now?
Yeah, it is showing as a presentation mode now. I think we can see it now.
Is it moving now?
Yes, the liquidity premium.
Oh, great. Okay. Um, so let me just do a quick recap. Let me do a quick recap. Now, from real risk-free rate. Now, risk-free rate is the is that rate that reflects the time preferences. And here's what we mean. What brought up the question of time value of money really is the fact that cash flows from two different periods are really not equal when we look at it theoretically. And how do we equate it? The way to equate it is by introducing the magical R, that is return. And we say at the minimum, at the least, the real risk-free rate of return is that return that compensates for time preference. That is, given everything else, it is real rate of return that compensates me from for forgoing the cash flow today and accepting to get it in a year's time. Now, when you then begin to change some of the other parameters, then you must then include premiums. And one of the premiums we've talked about is we've talked about 3 or 4 premiums. We've said the risk-free rate is for a single period. The moment you extend it to multi-period or you extend it to longer period, then you must include what we call a maturity premium. We are also saying that the real risk-free rate is completely risk-free. The moment it is not, then you must include a default risk premium. The real risk-free rate also has no inflation expectation. The moment there is an inflation expectation, then you must add an inflation premium. Therefore, the starting point of Mr. R is the real risk-free interest rate. But then in real life, you build that up by looking at some of the other parameters. If it's longer time, then you then have to add the maturity period. You then have to add inflation premium. If it's also for an issuer that is not that is prone to default, then you then also add default premium. Then if the issue is also not large enough, then you also need to add what we call a liquidity premium. So the starting point of R, that is R, that value that equates cash flow for 2 periods, the starting point is the real risk-free rate of return. But in real life, we have to build that up by adding all these other elements. So for example, when you look at the yield on bonds today in Nigeria, right? Now, what you would realize is that yield on the bond has factored in a lot of the premiums we've talked about. So you will realize that the yield on a 2-year bond or 3-year bond is different from the yield on a 10-year bond. That difference is driven by the premiums. These premiums we've highlighted here, right? You would also notice that the yield on a government security is different from the yield or the rate on non-government securities, say corporate. What is driving that is also the default risk premium that we've talked about here. So you see that the observable R we see in the market is driven by these theoretical factors that we are seeing here, right? And the reason for R, let's not forget, is because we are trying to equate cash flows from 2 periods. And that's what time value of money is about. And so the reason why I've taken time to go through all of this and break it down this way is the build up for time value of money is this equivalence. And what is driving this equivalence are these factors that we've just highlighted. The real risk-free rate of return, which compensates you for time preference, inflation, which compensates you for inflation expectation, default risk, which compensates you for risk, the risk of default, liquidity, which compensates you for lower liquidity, and the maturity premium, which compensates you for longer time to maturity or to recouping your investment. And so this is the page where we then have it all kind of summed up, okay? And I mentioned here, this is where I then spoke to the difference between investment 1 and then investment 5. Investment 1 and investment 5, to say that the maturity period for investment 1 is 2. Therefore, it's shorter maturity. It has high liquidity and has low default risk, right? Now, the way to interpret this or the way to understand this is to see that high liquidity is preferred to low liquidity. With low liquidity, then you need to add a premium. Low default is preferred to high default, right? If with higher default, then you must add a premium. And so when you look at investment 1 and compare it to investment 5 has longer maturity, It has low liquidity, which is less desirable. It has high default risk, which is less desirable. And because of that, the interest rate is way higher than for investment one at 6.5%. The factor that drove the interest rate from 2 to 6 are the premiums for liquidity, the premium for default, and the premium for maturity that are embedded in that instrument. So that's what I try to explain with this. And with this question, it's here I mentioned that in CFA questions, look out for key, right? Because when they set their question, they would typically drop some keys that is like a pointer to the answer. And so for this particular question, which is called from the curriculum, the key here is small private issuer. Small private issuer typically have small issue, a small issue of their securities, or trading. What that means is that volume is small. Because volume is small, liquidity, it will have low liquidity because volume is small. Compare that to US Treasury. US Treasury has high liquidity because there is high volume of that particular issue in the market. So it has high liquidity. So most likely the answer for this particular question would be liquidity. The major factor that explains the difference in the yield would be liquidity, not inflation or maturity, because they are both facing the same time horizon from an inflation and maturity point of view. Now, having talked about R, which like I said is the key thing in time value of money. Now let's begin to now look at time value of money in terms of application and in terms of how we walk through it, especially in the CFA curriculum, and especially also how it builds up and how we see it in other parts of the curriculums, right? In other courses, maybe portfolio management, fixed income, and the rest. From here, you begin to gain some insight into how we actually use this or how this play out typically, even practically, out there. Now, a very effective way to understanding time value of money is to imagine this line. This line being starting from a time period 0. Now that time period 0 is called present value, and you can say that is today, right? Anything that is indexed to 0 is 1. That is from equation. Some of us we're familiar with equation. Anything indexed to 0 is 1. What that means is if I give you 100 naira today, then it is worth 100 naira. But the moment you move from today, then it is no longer indexed to 0. It's no longer indexed to today. Then the value of that 100 naira must change. That's what it means. And what drives that change? What drives that change is this simple formula that is displayed at the top right-hand side, which is future value of any amount is simply the present value multiplied by 1 plus R. R will be the rate of return we've been talking about earlier, that we've talked about, raised to power n, and n being the number of period. So when you go back to the line, you will see that our line starts from 0, 1, 2, 3, up to n minus 1 and then n being the last period. And therefore, take, for example, that this is a cash flow you're getting in year 5, right? Let's say n therefore is 5. It means that for you to calculate it, you need the rate of return and the initial amount, which is the present value today. When you put it into this formula, you are then able to calculate what the future value would be. Now, think about it from a practical use point of view. When you go to a bank and you do what we call a fixed deposit. Now, let's say you do a fixed deposit of 1 million naira. You will notice that the banker will tell you that they're going to give you a rate of return of, say, X. And in this case, let's say it's 20%, just as an example. Now, if they give you a rate of return at 20%, and let's ignore taxes and every other thing, and every other charges for now, and you place that money for the next 1 year, What you then get at the end of the period can be calculated as the future value. The future value meaning the amount you will get at the end of the period. And that will be your present value, which is the 1 million, into bracket 1 plus R, the 20% that you're given, raised to power n, your n in this case being 1. Now, if you say n is 0, it means you are in today. If you do that calculation, you will still end up with 1 million, which means your 1 million today is still worth 1 million today. But the moment n is not 0 and n is 1, that value is going to change. And so when you calculate it that way, you're going to get a value, and the value you get is the future value of your 1 million. Now, what is the implication of what we have just calculated? It means that if someone comes to me and say, can I give you 1 million now? Let's say for calculation's sake, that for explanation's sake, that this, when we apply this formula at 20%, that it gives us 1.2 million, right? And I think that's what it's going to give us, but let's just assume that that's what it gives us. If someone comes to me and says, should I give you 1 million now, or should I give you 1 million in a year's time? My answer or my response to this person is no. You can either give me 1 million now or give me 1.2 million in a year's time. The person might say, oh, but I'm giving you more. No, you're not giving me more, because 1 million, 1.2 million in a year's time is actually equivalent to 1 million now. That is equivalence. And that is the foundation of investment finance, and what this little formula and this little explanation really explains. So you then see that with that explanation and with that view, and then you can apply it to a lot of the investments and return and application that we see out there. So everything else you do that relates to return right now, when you think about it from the point of view of being a way to equate the cash flow for two different periods, it perhaps makes much more sense. Now, here are a few pointers you should take note of. We can add amount of money only if they are indexed at the same point in time. Now, what do we mean indexed at the same point in time? Now, let's go back to the timeline. Let's say year 2, for example. If I have cash flows in year 2, irrespective of the sources from which they may have come, irrespective of if they are negative or positive, I can add them together as long as they are indexed to 2. That is, as long as I receive them in year 2. What that means is that I could simply add up all of my cash flow for a particular index period. But I cannot add my cash flow from different periods. I cannot. It won't make sense. So that is very critical, that you can only add amount that you get. From a calculation point of view, therefore, it means that if you invest for a customer, let's say a customer invests, this is another example, they invest in treasury bills, they invest in stocks, they invest in bond. As long as the cash flow they get is for a particular year, you could easily add the cash flow from bond to that of stock, to that of treasury bill, and do calculation on it, because they are all indexed to the same period. It doesn't matter if they are coming from different type of instrument, but as long as the cash flow is coming in the same period, you can add them. For a given interest rate, future value increases with the number of period. Now, let's say that the interest rate is the same. The more you increase the number of period, the higher future value you get. Now, go back to the formula. Let's say that R remains constant at 20. If you change N to 2, to 3, to 4, you will get higher future value. That is the second implication. And then the third is, for a given number of period, the future value increases with the interest rate. That is, let's assume that N remains at 1. If I move R from 20 to 30, I will get a higher future value. So these are some of the characteristics and some of the relationship and some of the basics of time value of money that CFA expects you to understand and know in level 1. What that means is they could set up a question for you and just change with the same period and everything. They put value to it. They say it's $30 million. One is 5 years, one is 4 years. The rate of return is 20%. And they tell you that which one has a higher amount. You could calculate it by using this formula to see the one that has a higher amount. But if you understand this relationship we've just talked about here, you do not need to calculate anything. And that's what I meant earlier when I said that for CFA level 1, you might see calculation questions that really do not require calculations. Because when you understand that as long as they are indexed to the same period, but the rate of return for one is higher than the other, then the one with the higher interest rate will have a higher future value. That will be your answer. You do not need to calculate it. Of course, you can calculate it to actually get the numbers, but when you understand the relationships, you will still be correct. So I'll just keep this. Now, in the CFA curriculum and in real life generally, a bit of complexity might be thrown into the question. One of the complexities that they can throw into the question is to say that, look, the interest rate or the interest rate is not exactly for a year, but the compounding period is not. Now, what do we mean compounding? What do we mean by compounding? It's an important concept. Compounding means that you're earning the rate at which you're earning interest, on interest that you have earned. Now let me use an example. 5% on 100 naira, the return is 5. But if I say that the compounding period is 1 year, is less than 1 year. Let's say the compounding period is every month. I'm saying that I'm going to calculate that 5% on 100 naira, and I will do that every month. What I'm saying implicitly is that the return I make after 1 month, I will invest it in month 2, which means that return will start generating its own return from month 2. Now, this is how you separate it, or this is how you identify, or you can structure it in your mind. If I say that the compounding period is annual, it means that I will wait to the end of the year to give you your 5 naira on the return on the investment, and then you can do whatever you want to do with it at the end of the year. You don't have access to it until the end of the year. But if I say that the compounding period is monthly, it means that at the end of month 1, I'm going to give you something, right? Which is still going to be prorated or calculated based on the 5% we agreed. But from that month 2, I can take that money, that small portion I've collected, and go and use it. In an investment thinking point of view, I could easily take that small portion you have given me and go and put it in another investment that is generating the same rate of return. Which means if I get money monthly, I will eventually end up with a higher number in December than if you wait till December to give me the 5 naira. Even though the return might not change, the return will not change from 5%, the capital will not change from 100 naira, but if you give me something back every month, I will have more money at the end of the year than if you wait till the end of the year to give me back the money. Now, the frequency of you paying me back is what we call compounding period. So questions might be set up to say that compounding period is X. What that tells you is that in your calculation, you must then factor in the frequency of compounding into your calculation. And the way to do that is in the formula at the top right hand. Now, what you will notice in this formula is it is very similar to this formula, right? Except that in this new formula, you divide R by M and then you multiply N by M as well. What is M? M is the compounding period, the number of compounding per year, the number of times that the issuer decides to pay you back something in a year. Now, if the compounding period is quarterly, it means that every 3 months you get something back. What that means is that you are going to have four compounding period. That is, your M is equal to 4 because we have 4 quarters in a year. And in this case, how you adjust your formula is that you will divide your R, your stated annual interest rate, by M. That is, you divide it by 4, and then you multiply your N by 4 in calculating your return. It's also possible that return you can compound indefinitely. When you compound indefinitely, it has a special formula which uses an exponential. Is this? I mean, if it's compounded continuously, the question will tell you it's compounded continuously. So the way to know what to use or what type of complexity has been introduced is actually to look out for the key in your question. Any question that is continuous, and I mean in level 1, will tell you in that question that interest rates computed continuously or compounded continuously is going to be stated. This is not level 3 where some words might be quoted in such a way that you might not easily understand what it is. But in level 1, they use languages that that is easy to understand and that also gives you a key to what they're trying to talk about. And so here is a full view of compounding. Now, if you compound annually, and I would just want us to focus on the future value, if the future value, which is at the end, the last column, right? If the interest rate is 8%, stated annual interest rate, if you compound annually, it means that the number of compounding period is just 1. Your n multiplied by m is going to be 1. And at the end of the day, you will get $1.08. Now, if you compound semi-annually, which means twice, what you will get is $1 and it's just slightly above 8 cents, 1 cent. And you can see that is higher than if you compound annually. If you take that to daily is 365 days. You see that what you will get is way higher than semi-annual, quarterly, monthly. And if you compound continuously, it's even higher, right? And you will see that has the highest number. Now, how my question come up from this? If you're given a question with different compounding period, if every of the other parameters are the same, the one that has the instrument or the investment that has the highest number of compounding would have the highest value, future value. The highest value being continuous. Continuous will always have the highest of return or the highest of future value of all of the frequency of compounding. Continuous. And so that's how to just think about it. I'll not dwell so much on this. These are exponent rules. Now, for a lot of the formulas, equations used in QM, they follow the exponent rules. They derive them using the exponent rule, and they also modify them using the exponent rules. So you might see a formula written in a certain way, and then they will break it down into another way, right? Just to make it either simpler or to make it to fit into a certain description, or to show you the equivalence of that formula. And the way they do it is to apply the exponent rules to it. And these are rules that are used in equation. And I mentioned earlier, the zero rule, for example, anything that raised to power 0 is equal to 1. And the implication of that is to say that anything that is raised to power 0 means today, which means the value of that thing is equal to what you have today. What that means is 0 means today. So if I say 10% today, I'm not getting, the value is not going to change because I already have what I have today. And as long as it has not moved from today, the value remains the same. And that's the zero rule. Zero rule says that anything raised to power 0 is 1. The product rule, for example, the product rule means that you can multiply if it's the same index raised to the same different values. You could simply just add the values together. If it's multiplication, if it is division, you just subtract. Now, these are exponent rules, and they are applied. They are applied in probability. They are applied in time value of money, as we have seen. You will see it later, even in estimation and hypothesis testing, they are also applied. So you might want to take note of this and just go through it to be sure that you understand. It also helps you to break down concepts or formulas as the case may be. Present value of lump sum. Present value of lump sum. Present value of lump sum is it's broken down into two. What do I mean two? The way to think about it is to break it into two. When we say present value of a lump sum, it means you're looking at a lump sum, which is a future amount, and you want to find what the present value is. Essentially, the question you're asking yourself is, what is the equivalence of that future value now? So when we talk about present value, future value, what we're talking about really is equivalence. How do we find equivalence of something, the value of something today in the future, or the value of something in the future to today? What that means is that if and let's use exhibit C, or let's use the example. If you promise to give me $100,000 in 6 years, how much should I be willing to take today that is equivalent to $100,000 in 6 years? That amount is the present value of $100,000 and it's $63,000. That's what it means. Which means I should be indifferent between taking $63,000 today or taking $100,000 tomorrow. Now, this has implications for assets. If I know that the present value of this particular asset is 63 right now, and then in the market, it is selling for 60, what that tells me is that it is worth much more than it is selling in the market, which means I should buy it. What if it's selling in the market for 67 today? It's telling me that the present value is 63, which means it is way higher than its actual value. Therefore, I should sell. Now, the reason why I'm bringing all of this concept, all of this view into it is for you to say that this concept of present value, lump sum, future value, they have implication in all of the other courses that you're going to be doing in asset valuation, asset pricing, and all of that, even in option pricing and all of that. That is why I believe CFA has brought it out to say this is a prerequisite reading. You need to be grounded in this concept for you to be able to apply it elsewhere. I mentioned earlier that the present value of a future lump sum is a combination of two factors. The first one being the future value, right? And the second one being what we call the present value annuity factor. Now, in a question, if you're given the present value annuity factor, it's a number. If you're given that, then you can simply multiply that by the future value to get the present value. But if you're not given that present value annuity factor, then you have to calculate it. And the way it is calculated, it is in that green box that you can see. It's 1 over 1 plus r raised to power n. We've talked about what r is. We've talked about what n is. So it's all you need to do is to look at your questions, identify r, identify n, slot it into this formula, and multiply it by your future value, and then you will get your present value. At this point, let me explain a concept that makes solving questions easy. When you see a particular question, when you see any particular question, the first thing you want to ask yourself is, what is this question asking for? You must be able to identify what the question is asking. And I'm not saying solve, I'm saying asking. Now, I'll give you an example. If you see a question, let me see if there's an example here. Yes, let's use this as an example. A saver deposits the following amount in an account paying a stated annual rate of 4%, compounded semi-annually. At the end of year 4, the value of the account is close to. Now, this is a question. And I know you can apply some of the formulas we've talked about to solve it. But the thinking really is, the first point is what is this question asking me? Is it asking me to calculate a present value? Is it asking me to calculate a future value? Is it asking me to calculate the present value of a single cash flow, or present value of or a future value of multiple cash flows? What is it asking me? You must be able to first identify what the question is asking. Define what the question is asking will then take you to what tools do I need to apply to solve the problem. If you then realize that or identify that the question is a future value problem, then what future value tool do I need to apply? So for example, we've talked about tools. Tools are like formulas. Here is an example of a tool. This future value formula is a tool, which means you can apply this tool, that is this formula, to solving that problem. But if you do not know, for example, that what you are being asked is future value and you think it's a present value, what the formula you are going to go to take is perhaps the formula of present value, which we talked about earlier. Okay, we've not gotten to present value. Now, which we talked about earlier. If you then apply the present value formula to it, you will get a different result. So, first step, what is this question asking me? Is it a present value? Is it a future value? Once you identify it, you then say, oh, now that I've identified it, what tools do I need to apply? In the examples we've looked at, there is a future value tool that you use when you are dealing with a single compounding. When you're dealing with multiple compounding, it's a different tool. So you see that even when you have identified what you need to do, you still need to select the correct tool to apply. And the correct tool will be a question of you then asking how many times is the compounding. For example, this question already says compounded semi-annually, which means you're not looking at one compounding, you're looking at multiple compounding, at least 2 compounding. What that means is that the tool to use is not just the R tool, it's the R over M tool. That's what you need to use. So think about it that way. When you see a question, ask yourself, do I know what this question is asking me to do? Identify that first. Then ask yourself, what tools do I need to apply to this out of the tools that I can use for this particular problem? And then you select the right tool to use. I'll just, using the same view as future value, you can also calculate present value. You can calculate what we call the present value of an annuity. Now, what is an annuity? An annuity is a stated amount that does not change. It's a steady flow of an amount an amount that is a stated amount. It does not change. In this example, the question says an asset that promises to pay 1,000 per year for 5 years. So 2 things to take note of when we talk about annuity. Number 1 is that the promise of the amount is the same throughout the entire period. The second is that the time period is graduated in the same way. Now let me put that in another, let me make that clear. This question says 5 years. 5 year is a standard measurement, which means if I get 1,000 today and I get 1,000, another 1,000, I know that the time difference between the first 1,000 and the second 1,000 is the same. It's exactly 12 months. If I get another 1,000, I know that the difference between the last 1,000 and this 1,000 is still 12 months, which is equal to the difference between the timeline of the first payment I got. Now, that is very important in annuity, because in annuity, the amount does not change, and the difference in timing is also constant, which means if it's yearly, it has to be yearly. You cannot get a cash flow in January, get another one in August, get another one in March, get another one in July. That is not an annuity. In annuity, the periodicity must be the same. And if the periodicity is not the same, applying this formula would not give you the right answer. And the tool to use for present value of annuity is stated here. Again, is broken into 2. There is the annuity, which is in your question, you will see it. It will always be stated as annuity. The word annuity might not be used, but in this question, it says that it promises a steady sum. Now, how do you know an annuity? use what I have said earlier, two things. Number one, is the amount or the cash flow the same over the period? If the answer is yes, the second question is, do they come at regular interval or the same interval? If the answer is yes, then you know you are dealing with an annuity. If the answer to both questions are not are not the same, or say yes, then it is not an annuity. So that's how to look at that. There is the difference between an annuity and an annuity due. An annuity due, typically when we look at investment, we look at investment from point zero. So for example, point zero means if you give me 1,000 now, it's going to be 1,000 today. Before I can get a return on that 1,000, it will be in a year's time. Now, what if the question is that I'm giving money, in this case, an annuity? The assumption is that the first payment will come in a year's time, which means if I'm promised an amount, then the first time I will get payment will be in a year's time. The promise comes today, I will get payment the following year. But if it is that I get a payment today on day one, and then the next payment is in day two, it's called an annuity due. What that means is that you're getting your first payment immediately. The implication of that is that you can as well invest that first payment immediately today to earn a return. So there is a difference between an ordinary annuity and what we call an annuity due. So these are just practice questions based on all that we've discussed. When looking at time value of money, it's important to use your timeline. A very simple way to understand and to solve any present time value of money question is to look at time, is to use the timeline. The reason being that sometimes the question might tell you that the cash flow is received at time X. The timing of the cash flow is important to the calculation. So for example, if the question says I get my first cash flow in year 5, if I do the calculation like I'm getting it in year 1, I'm going to be wrong. Look, you may end up having the same time frame in terms of period, but the rate of return or the discount or the present value annuity for year 1 is different from the present value annuity for year 5. The present value annuity for year 5 already has built in the fact that there is a maturity premium into it implicitly, even though it's the same rate of return. Therefore, the value you will get in year 5 will be way lesser. It will be lesser than the value you will get in year 1. And the way to see that is if you take your calculator and you just do 1 over 1 plus your R, right? And if you use 10%, for example, the first number you will get is 0.9. Now, when you multiply that by your sum, it's going to give you what that means. What that translates to is 90% of your amount. But by the time you do for year 2, that 0.9 might be 0.8, which means you're only getting 80% of your actual value. If you press it again, it will give you for year 3, which will be around say 0.77. That is for year 3, which means you're only getting 77% of the value of whatever cash flow you're getting in year 3. By the time you get to year 5, you're probably at 0.64 or 0.63 or something like that. What that means is that whatever cash flow you get in year 5, the value you're getting from it is only 63% of that. Let's assume that you get 100,000 because let's say this is an annuity, so you get the same cash flow. The total value you will get in year 1 will be around 90, but the value you will get in year 5 from that same 100 will be 63 or 64, which means they are not the same. So it is important that you use your timeline to graduate where your cash flow would start from or where your cash flow is, and use the appropriate discount rate or present value annuity factor for that period to do your calculation. Now, just these are just questions, that can help to practice question that can help you to reinforce, what you've learned there. So this is on the first module on time value of money. Just to summarize, time value of the time value of money is very foundational to CFA. Everything you're going to be learning, I dare say, what you need to understand with time value of money is that it's about equivalence. How to equate cash flow for different periods. What makes sense in terms of equating cash flow from different periods? What we've looked at is the different approaches to identifying the tools we need to use based on the kind of example or the kind of questions that we get. We can either be looking for a present value, which means we have an amount in the future. We want to know what is equitable to, or what is the equivalence today. Or we are looking for a future value, which means we have an amount today. We want to know what it's equivalent to in the future. In answering those two questions, different complexities could be introduced. For example, there might be difference in the timing, in terms of the timeline of receipt of the cash flow. You need to learn how to adjust for that. There might be complexity introduced in terms of the rate, in terms of how often you compound. So you have to adjust for that. There might be complexity introduced in terms of the cash flow. The cash flow can either be different amount, or the cash flow can be the same amount. If the cash flow is the same amount, we say is, and it comes at regular interval, we say it's an annuity. Now, if you get the first payment at year zero, we say it's an annuity due. If not, we say it's an ordinary annuity. If you get different cash flows, that is, cash flows that are not equal, then you must find the present value of each cash flow differently, and then you sum it up. You cannot just use a formula to find the present value of different cash flows. So if you're dealing with different cash flows, you have to find the present value of each one indexed to the period when the cash flow is received, and then you sum up the resulting answer to get your the present value. So I will just pause here for a minute and also just take questions. I know there might be questions in the room that Do we have any question before we move on? Now, you can also make use of the you can make use of the chat. You can drop your questions in the chat if you have, and then I would at the end I would or at some point I would go there and read out those questions and also try to take them. All right, I'll just continue since there are no questions. Now, the second module is around data. Talks about data. Now, why this is foundational really is because data is the bread and butter of an analyst, in which you're one, and you're also aiming to become a better one through the CFA program. Everything you do is based on data. So this module really is about understanding data. What is data? How do you use data? How do you collate, summarize data? How do you interpret data? How do you present data? It's a curriculum. It's a module that I think it's very interesting. You would see parallels to some of the things you already do in terms of data, and perhaps a lot of the things you also see might also just pop out, make sense. So let's get into it. And again, I mentioned earlier, whatever you see here is directly from your curriculum, so don't worry. What is data? Data is the collection of elements in raw organized format to represent fact or information. So the way we represent fact or information is through data. And this could be numbers. It could be, we are very familiar with numbers. We are very familiar with numbers like population, familiar with numbers like prices, we're familiar with number like exchange rates, interest rates, and all of that. But data could also be character. In fact, data could be pixels, images. With AI now, AI can actually tell that two images are different, and what it will look at is the underlying data, that is the pixels, to say that, oh, based on this image is actually different or the same as this image. So characters could be data, words could be data, and we're talking about text, images, audios, videos. And in addition to the ones that we might already be very familiar with, which are numerical data. Now, data could be numerical or categorical. When we say it's numerical, just look at it that it's in its number. And here, this is the type of data we call quantitative data. Quantitative data. In our world, we are very familiar with this because we see it every day. We crunch these numbers every day. Now, numerical data could either be continuous data or discrete data. Now, the difference between this continuous and discrete is a subtle one. And how to think about it is this: they are both numerical data, but one can take any value, but the other one is as a result of counting. Therefore, it cannot necessarily take it can only take a specific value. An example is, if I say the number of months in a year, it can only be 12, or it could be 8. Or say if I say months in a year, it can be 12 maximum, or 11, or 10, or 2, but it cannot be 2.5. And that's what we mean by discrete data. So discrete data can only take a district number, and that is because it's an outcome of counting, something that can be identified, something that can be counted. Continuous number can be anything. It can be 2.7003339 or 3.28825. That's continuous number. But discrete number is discrete. Really, that's just the major difference. We also have what we call the categorical number. The categorical data. Categorical data essentially is what you will call your qualitative data. Your qualitative data. And in your categorical data, we have what we call the nominal data and the ordinal data. How do you differentiate these two? Nominal, you cannot order it. I mean, it doesn't make sense for you to order it. For example, boy and girl. If in a room there are 5 boys and there are 10 girls, can you order it? If I say order by gender, which one will you put first? Which one is first? Will you say boy first and then girl second, or girl first or boy second? It doesn't make sense ordering it. I mean, even if you end up ordering it, the outcome is really not very sensible. Because by ordering it by putting boy first does not mean that boy is ahead or boy is first or boy is better. Or if you put girl first, it doesn't mean that boy is ahead or boy. So you can't do any calculation that gives preference to the first one you put there. That is a nominal data. Ordinal data is still qualitative, but it can be ordered. An example of a qualitative data is position. First position, second position, third position. Right? Now, first position, all the first, second, third is qualitative, it's not numerical, but you can order it, which means you know that first position is clearly better than second position, and second position is clearly better than third position. So you can order it. So that's called ordinal. Nominal is the one you cannot order. A way to think about this is in real life or practically would be to look at credit rating, for example. Credit rating. If you look at credit rating, triple A, double A, B, C, and all of that. Now, these are categorical data. They are qualitative data, but you can order it, which means triple A is better than A, double A is better than A, and the likes. So you can. But can you order, for example, the industry nomenclature? For example, you say that a company like MTN is in telecommunication. Let's say there are 3 telecoms companies, there are 6 oil and gas companies, there are 10 financial services companies. Can you order them? No, you cannot. Because on what basis will you say telecoms is first and banking is second and healthcare is third? It's ordering it does not make sense. So that is an example of nominal data in real world application and an ordinal data in real world application. So, but the major difference between numerical and categorical is that one is number based, is quantitative, the other one is qualitative. Now, it's important to explain what a variable is and what an observation is. A variable is a characteristic or quantity that can be measured, counted, or categorized and is subject to change. So it can be counted, it can be categorized. I mean, you can work with it, but the most critical point in all of the things mentioned here is that it is subject to change. It is subject to change. So for example, stock price. Stock price is a variable, which means stock price can be 2 for so Zenith can be 2 today, 2 naira today. Tomorrow is 3 naira, as an example, which means it's subject to change, right? The same thing for market capitalization, the same thing for dividend yield. But what is an observation? An observation is the value of a specific variable collected at a point in time and over a specific period of time. So, for example, if I say that in 2023, DEF Incorporation records an EPS of $7.5, $7.50, right? That is an observation, because if I come back 10 years time and I look at the EPS of DEF in 2023, I will always get 7.5. But that observation relates to a particular variable. Yeah, that variable can change, but when I observe it at a particular point in time, it is an observation. So really that's the clear difference between variable and observation. And then data can be presented in three main formats. We have what we call the time series, we have the panel, and we have the cross-sectional. Data is presented in time series when you take one variable and you look at that variable over time, over different time period. And that is denoted by the green box, for example. So you can see that company A, their performance in their EPS in Q1 is 13.5. Still for company A, in Q2 is 4.3. Q3 is 13.16, 13.16, and in Q4 is 12.95. Now that is your time series data. It is one variable, different time periods. What about cross-sectional? Cross-sectional look at one time period, but different variables or different elements. In this case, we are looking at just one time period, which is Q1, but we then have for Q of the EPS for company A, company B, and company C. Now, because we have one time period and multiple elements or multiple variables or elements, let me use element, that is called cross-section. That is called cross-sectional. It becomes a panel when it looks at it from a two-dimensional point of view. That is, it looks at it from over a time series and also look at it from a cross-sectional point of view. And that is why you see that the red bucket is called panel. It's called panel or a data table, or as the case may be. So these are the three ways in which data can be presented, either in a time series or as a cross-sectional or as a panel. Now, there are two types of data. We have what we call the structured data. Structured data has been organized in a predefined manner and usually in a repeating format. Now, what we saw here is an organized data because we already have a format, time period, and company A. Therefore, it's already sorted. This is an organized data or a structured data. You can do a lot of analysis and a lot of stuff with this type of data, right? But an unstructured data do not follow any conventional or organized form, right? An example of your structured data is your market data. When you get the daily closing prices of stocks, for example, you can see it's already organized. It's already organized according to the companies and their closing value. So if you want to know the closing value of a particular stock, for example, you simply look for the that stock, and then you trace the closing value and you get it. That is because it's already structured. Fundamental and analytical data are also structured. Now, what about unstructured data? These are data, the type of data produced by individuals through take for example, social media posts. Now, why do we call this unstructured data? It's because it's really not organized in any way. The data is as random as the thought of the person typing it. For example, I could tweet today that, oh, I'm feeling happy. Now, I could either use the word happy, I could use excited, I could use light, I could use so many different synonyms to happy, right? Now, but I'm at the discretion, it's at my discretion that I will say whatever I want to say. And whatever I say is not structured in any way. There's no format to it. I can say anything the way I want to say it. I can decide to be poetic. I can decide to be, in any way, and I'll put it out there. Some unstructured data are also generated by business, maybe via credit card transaction, for example. Corporate regulatory filings, these are some of unstructured data. They can also be generated by sensors. When you look at the satellite imagery that we see, or we look at the traffic of mobile devices, there's no structure to it. It just pops up. It is what it is. But you then have to find a way to structure it. When we deal with unstructured data, do we have tools to actually put them in a structured format? Do we have tools to make sense of unstructured data? Right? These are some of the questions that this try to that we'll see. We'll try to find answers to in this model. Then data can be presented in what we call one-dimensional array and two-dimensional array. Now, what do we mean by one dimension? It's simple. You are looking at it from one angle. That is the observation and the value of that observation. Simple. Now, on observation day one, for example, on the table to the left, the stock price on that day is 57. And then you move on to day two, and the stock price is 58. But when you look at two-dimensional array, we are looking at different factors. So in Q1, year one, there is revenue, there is EPS, there is DPS. When you compare that to the one-dimensional array only has one variable for each observation, right? For a two-dimensional array, for each observation, there are different variables. And that's how, and this is also called a data table, right? And so that is two ways in which data can be, can be formatted or arranged in one-dimensional or two-dimensional. Now, we then also look at frequency. When we look at frequency, we start looking at how do we put together data together. Recall we talked about structured data and unstructured data. Let's say we have our data structured. Now, what do we then do? How do we begin to make sense of it? How do we begin to put it together so that we can make sense of it? The very first step or the very first thing is we can put it in what we call a frequency table. A frequency table is a tabular display of data constructed by counting the observation of variable by distinct values or groups and then tallying the value into a set of numerically ordered being. Now, this tool is very useful for initially summarizing data by beings. Now, what do we mean with all of this? Now, look at the table to the right. There are different sectors, the industrial sector, the information technology sector. Now, you will see just next to it what we call the absolute frequency. The absolute frequency is the actual number of observation for that particular variable. Now, for the industrial, for example, it means that we have 73 companies in that bucket. So the number of observation of the observed industrial sector company we have is 73. That is called absolute frequency. For information technology is 69. For real estate, for example, is 30. And for communication services is 10. We can then calculate what we call a relative frequency. Now, relative frequency takes the absolute frequency of industrial and compare it to the total. Now, the total in this case is 479. So by the time I take the absolute frequency of industrial, which is 73, over 479, I'm going to get 15.2. 15.2 is then the relative frequency of industrial. That is, another way to look at it is the portion, the total, the portion that represents industrials in the whole pie is 15%. That is 15.2% of the companies in that market actually belong to the industrial sector. That is how to interpret it in from a practical point of view. That's what relative frequency means. Now, relative also tells you that it's being related or is being compared to another thing. Absolute is not compared. Relative is compared. And what is it compared to? It is compared to the total sum. Therefore, by looking at the relative frequency, what can you get? By looking at the relative frequency, you can then see that we have more industrial companies than energy companies or than communication services, because the relative frequency of communication services is 2.1. The relative frequency of industrial sector is 15.2. So you can make sense of this data by looking at both the absolute frequency and then the relative frequency. Again, the answer to different questions. How many industrial companies do we have? Absolute frequency 73, right? Relative to the total number of companies in the sector, what is the portion of the total number of companies in that particular market that are industrial? That is answered by the relative frequency, which is 15.2. You can also use it to answer the question of comparison. Which industry has the highest number of companies between industrial and communications, for example? So that's what you can use absolute frequency and relative frequency to mean. There is one other frequency that is not here, what we call the cumulative frequency. You can have what we call the cumulative absolute frequency and the cumulative relative frequency. What do we mean by cumulative average absolute frequency? If at the beginning, if I look at the industrial sector alone, it's 73. If I then move to information technology, that is, I'm adding industrial to information technology, right? The absolute frequency would then be 73 plus 69. If I then add the financial services, I would then have to add the 3. But in terms of relative frequency, right, cumulative relative frequency, what I will be doing is adding their relative frequency. That is, when I'm looking at the industrial sector alone, it's just 15.2. When I then consider the information sector, in the information technology, 14.4. Now, you may think that, what's the meaning of this, or how useful is this? If I want to know, for example, how many number of companies in the market are either industrial or information technology, how many, the number? What I'm looking for is the cumulative absolute frequency. What that means is I'm going to add 73 to 69, and I'm going to get that number. And that is the total number of companies in that sector that are either in industrial or information technology. What if I want to know how much that represents? That is, taking that number, what does it represent from an aggregated point of view, that is compared to the total number? Then that would be 15.2 plus 14.4. In this case, that would be 29.6. That is 29.6% of the companies of the companies in the sector belong to industrial and information technology. That's what it means. So I can use my cumulative relative frequency to answer that question, and also can use my cumulative absolute frequency to answer the question of how many are they in total for those two sectors. We can also use what we call the contingency table. Now, the contingency table is different from the frequency table. The frequency table is a one-dimensional table. So as you can see, for the frequency table, it looks at the element and look at the observation, just one. In a contingency table, it has more than one variable. that are relevant. So it looks at the variable from two different dimensions. And here is a very good example. Now, you're still using that same example we had. If we put that into a contingency table, what do we have? Communication services, that's the sector, but 55 of them are small cap, 35 of them mid cap, 20 of them large cap, giving a total of 110 companies in communication services. What that means is that we can say, oh, how many companies are in telecommunication services? Communication services rather, 110. But out of the 110, 55 of them belong to small cap, that is, they are small scale. 35%, 35 of them mid cap. 20% are 20 of them are the large ones, right? Now, what this means from an interpretation point of view is that the 55 is called, under the small cap, is called joint frequencies. Why is it called joint frequency? Because it represents a nexus, that is a joint between small cap and communication. It is a factor that represents two variables at once. That is, if I pick that 55, it means that every company in that 55 is both small and belongs to communication services. Therefore, it's called joint frequencies. But when I then add all of the joint frequencies for a particular variable together, what I get is called marginal frequency, and that is seen in the green in the green circle. That is, when I add 50 to 30 to another 30, what I get is 110, and that 110 is called marginal frequencies. But when I pick just one, as in the 55, what I get is called joint frequencies. And that's essentially just understanding contingency tables. Now let's look at some data visualization. When we say data visualization, we've looked at some of the data. We've talked about data in tables. We've talked about it in, contingency table, frequency table. But how do we visually represent data in a way that it is easier to understand, in a way that is easier to interpret? Questions could be, what is the best way to actually represent a certain data that it is able to communicate effectively what we want it to communicate? Now, there are different tools available, different visualization tools available. And some of them that have been covered in the curriculum I've just put here, right? They are visually striking, beautiful to see. So really, I just replicated them. We have the histogram. The histogram we have here also have the frequency polygon embedded in it. Now, the histogram represents data in bar chart, but it represents it in range, right? It represents it in range, and the way to look at it is when you then look at the different range or the different bins, and you look at the occurrence or the number of observation there, you then represent the total number of the observation in each of the bins in a bar, and the bar is going to be equivalent to the total number of observation. For example, in the histogram, for example, you can see that for the range between 0 and 1, index return of between 0 and 1, the frequency is around 600. Whereas for the frequency between -1 and 0, the frequency is around 480. For the frequency between -2 and -1, it's around 100. And so representing data in a bar chart like this, it's called histogram. And when you then plot the midpoint of the histogram, what you get is called a frequency polygon. So the dotted line is called the frequency polygon. Other interesting way of representing data, we have the bar chart. The bar chart is like your histogram. It represents data in bars, but each bar is equivalent to the number, the absolute number of each of the variable. So, for example, communication services is about 100 or 110. Consumer staples is about 110. Healthcare is over 400. The bar chart helps us to be able to compare data easily. For example, if I want to know the sector that has the highest number of companies, I could easily answer that question here, that is the healthcare. And I can easily say that the total number of companies in the communication services is roughly equal to the total number of companies in consumer staples. And both companies do have companies more than the utility sector. So looking at this bar chart, I can actually interpret and explain what I see there, even though we don't have so much numbers here. So I can see relatively, I can compare, I can know which one has the highest number, I can know which one has the lowest number, and the like. We can take bar chart further by coming up with what we call a grouped bar chart. Now, a grouped bar chart is not so different from bar chart, except that rather than have just one representation of the bar chart, you can group it. So, for example, in the data we have, there are 110 communication services, but 55 of them are mid cap, 55 small cap, 35 mid cap, and some large cap. We can represent that, together in the bar chart, and that's what the group bar chart sees. So you can see that under the communication services, there are 3 bar charts, right? So there are bar charts within the bar chart. So you can see that for the small cap, the number of the small cap is represented, telling you that it's higher than the number of the mid cap, and telling you that that is also higher than the number of the large cap, all for communication services. And you can replicate that for the other sectors as well. So this is called a grouped bar chart. You can also have what we call a stacked bar chart. A stacked bar chart is different from a group bar chart, but because in a stacked bar chart, rather than place them side by side, you place them on top of each other. So look at the communication services. Rather than put the mid cap beside it, we put it on top of the small cap, and then you put the large cap on top of that, and so it is stacked. And that's the major difference between the stacked bar chart and grouped bar chart. We also have what we call the tree map. The tree map, when you look at it, really looks like a tree, and that's where it gets the name from. If you zoom this out a bit and look at it maybe from afar, you will actually see that this picture represents like a tree. This is how a tree is when you maximize and when you zoom it out. Now, how do you interpret this? It represents each of the observation in boxes equivalent to the value. So, for example, small cap, as you can see, is 275 in healthcare. But again, in the healthcare sector, there are a combination of 275, 105, and 55. All of that under healthcare. And you can see that the color coding. The color coding for healthcare is green, but the small scale size in healthcare is the largest. Therefore, within the green color or within healthcare, small size has the largest number, followed by the mid, followed by the large. In energy, small size also has the highest number, which is 172. Mid has 95 and large has 20. One thing you will notice here is that even though the small size of energy is the highest, it is still smaller than the small size of healthcare. Therefore, you still see that the box of small energy is still smaller than this box of small healthcare. So even though this small is representing energy, right, it's also representative of the overall percentage in a way of energy small in the total tree, or in the total in the total value, in the total data. Therefore, you see that the box for small energy is still smaller than the box for small healthcare. Even the box for small communication services is even smaller than the box of small energy and the box of small healthcare. So this is the tree map. You can use that to also explain or to visualize data. The word cloud is used mostly to visualize categorical data or non-numeric data or qualitative data. And the way this works really is it looks at the most used word and makes it bigger. So for example, when you look at this word cloud, what you can see is that wherever the data is generated from, let's say this is generated from a speech, the number of times billion was mentioned, clearly, it was mentioned a lot of time compared to maybe March. Therefore, what you can interpret this to mean is whoever came up with this speech cares so much about revenue, because you can see the person mentioned revenue a lot of time, mentioned billion a lot of time, was not so particular about advertising. You can see advertising is just small in at the side. Mentioned March, not so much, but year is much more important than the month, because you can see March is small, but the year is a lot. So this word cloud tells you which word people are using the most, and in a way use that to represent what matters to them the most, or what is of most paramount importance to them. Now, the Fed meeting, or like our own NPC meeting here in Nigeria, when the MPC committee, once they come up with their decision, there is in the US, for example, there are AI tools that they can use to read the test and use to decipher the tone or the attitude of each of the members to whatever decision they have made. And that way they're able to tell, to say, oh, even though they made this decision, but they are not very particular about it. They are not very aggressive about it, which means they might change their decision in the next meeting or something. A way to actually extract information from all of that text that they have is one way could be the use of word cloud. Then we also have what we call the scattered plot. Now, what's the scattered plot? Scattered plot typically just plot data on 2 dimensions. In this case, for example, you can see that the number of information technology guys the return or the return of S&P and the return of technology companies, different technology companies are plotted here. And you can see, in a way, it seems to be correlated with that of S&P 500. You can see each of the square or triangle you see there, it's representing a particular company or a particular company in relation to their returns and also in relation to the S&P 500. And we also have what we call the heat map. The heat map shows data in 2 dimensions. One is that it shows data from, it shows data in terms of the absolute number, but it also shows data in terms of intensity. From intensity. For example, 20 blue means that it is small, right? Amber means that it is high. You can use heat you can use heat as a framework. Let's say that this is heat, right? What this is saying that temperature of 21 is cold, right? Temperature of 99 is definitely hot. And because of that, you're likely to see occurrences that are associated with hot temperature at 99 compared to where you will see at 21. You are likely to see occurrences that relating to cold regions at 21. So what the heat map does is that not only is it showing the numbers, the number of absolute occurrence, it's also showing it in terms of the intensity of that occurrence as well, of that observation or occurrence as well. And that's what the heat map shows. And so those are some of the it's by no means exhaustive. This is just some of the tools that we can use for data visualization. In real life or in a practical application, what you would need to be able to do as an analyst is to say, what visualization tool best describe or best interprets my data? Now, so it would then be a question of selecting the right tool to express or to, to present your data. That really is the key question for data visualization. Understanding how to put that data visualization together, understanding how to interpret it, and understanding when to apply it in your data analysis. So those are the key questions that data visualization try to answer. At this point, again, I will just pause a bit and see if there are questions. If there are questions, we'll take that before we continue. Do you have any question? Okay. Then I'll just continue. Now, next we'll look at what we call measures of central tendency. What do we mean by measure of central tendency? Take the word central. Talks about the tendency of a particular data to be centralized, which means what can we use as an accurate measure of the central value of a set of data? That is, where is the center of a particular set of data? That's what a measure of central tendency does, or looks out for. But apart from measure of central tendency, we still have what we call a measure of location, which includes all the measure of central tendencies and other measures. Now, the reason why it includes the measure of central tendencies is because measure of central tendency on its own is a measure of location. So just that in this case, you're only measuring the center, but the center is still a location. So measure of central tendency is a subset of measures of location, right? And when we look at measure of central tendencies, we look at the mean, we look at the median, we look at the mode. And some of us might be familiar with this already, including the way it is calculated. When we look at measure of location, we look at the quartiles. That is when we divide that data into quarters, or we look at quintiles when we divide that data into fifths, or we look at deciles when we divide that data into tenths, or we look at percentiles when we divide the data into hundreds. We are very familiar, some of us familiar with quartiles and percentiles. Quartiles because we're very familiar with quarter. So when we say quarterly, there are numbers that are released quarterly. For example, GDP numbers are released quarterly, and so because we track those numbers quarterly, we say, oh, quarter. So that's an example of quartiles. Percentage or percentile is the one we are so familiar with. Anything that is represented as percentage is represented in percentile. So when I say 2%, it means I'm representing it in percentile. Anything that is in percentage is represented in percentile, which means it's represented as a relative to 100. So what I mean by 2% is that I'm saying 2 as a relative to 100, right? So now let's look at dispersion, measure of dispersion. Measure of dispersion is the variability around the central tendency. Now, measure of dispersion is in relation specifically to central tendencies. So when we are measuring dispersion, it means that we must start with a center point. We are relating whatever we are calculating to a center point. We are calculating deviation from a center point, which means the starting point of dispersion is central is the central tendency. And there are key, excuse me, at this stage, there are 4 key measure of dispersion that we look at. 4 key measures. Please, a moment. Excuse me. Now, there are 4 key measures of dispersion that we should be familiar with at this level. There are others clearly, but they are simple, simple to relate with, simple to simple to use as well. And I will just go through them, understanding explaining the very basics of them. The first one is the range. The range is simply the difference between the maximum number and the minimum number. It just tells you how wide apart the value is, the values or the data, elements are. By the time I look at the biggest number and I subtract it from the smallest number, what I get is tells me how wide apart the data range is, and that is your range. It's as simple as that. We also have what we call the mean absolute deviation. Mean absolute deviation. Now, at this point, I want to introduce you a bit to formulas. And these are some of the formulas that you need to get familiar and comfortable with. And the reason why I'm introducing it at this level is so that you will see a lot of formulas that looks like this. And a lot of some of the challenges that level 1 candidates have had is that by looking at this kind of formula, you just get the impression that this is tough, this is hard, this is difficult, but not necessarily. And so here's how to think about it really. First, break this down. This formula at this side, MAD means mean absolute deviation, absolute deviation. Now the sigma side, the E sign or the sigma sign simply means that you're adding together all of the occurrence from I being your 1, I being the first one, the first occurrence, up to N being your last occurrence, right? So if I have 10 data or 10 occurrences, what that means is that I'm going to add from 1 to 10. That's what that part says. Now, the X1 is each of the observation. Now, when you look to the right, for country A, the observation for year 1 is 19.1. So that is the X1 for country A for year 1. So it's really simple. And for country B, the X1 is 4.3. Now, the X bar is the mean. The mean is the simple mean. And I'm sure a lot of us were already familiar with what mean is. And mean essentially is that you sum all of the occurrences and you divide it by the N. You divide it by the number of occurrences. So in this case, we have A to K, which means I will add 19.1 to 4.3 to 1.8, and then I will divide it by N, which is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and 11. I will divide it by 11. Whatever value I get is my mean. What I will then do, what this formula says is that I will then take each occurrence and then deduct the mean from it. And so for country A, I will say 19.1 minus the mean. Let's assume that the mean is, say, 23. I would then say 19.1 minus 23. I would then get a number. In this case, I'm going to get a negative number, right? Now, the two bars behind in front of X1 and X bar means that you're looking at the absolute, meaning that you are going to ignore the signs. That's what that sign or symbol means. So in my example, 19.1 minus 23, I'm going to get a negative number, but it's telling me to ignore the negative number. So let's say it is minus 3.4 as an example. I'm going to ignore the minus and only use 3.4, which means at the end of the day, across board, I'm going to get only positive numbers because I'm going to ignore all of the signs, which means I'm going to end up having positive numbers, even for where the answer is negative. And then I'm going to add everything together. and divide by n. That is, divide by 11, like we have seen. And whatever answer I get is my mean absolute deviation. Now, why I brought this out specifically is as you go through QM, and QM is one of those it's that course where a lot of candidates just just think it's hard, it's difficult. When you look at all of these formulas, it's just all over the place and all of that. My advice is that no matter what, just break it down and walk through it. In fact, when you see a formula, rather than focusing on the formula, use questions to understand it first. Don't try to wrap your mind around the formula. Most times when you use the question, when you walk through the question to get the answer, the formula will make more sense to you. For example, if I look at this formula and what it's saying, it may look like, what is this saying? But if I go through the process of using my x1, finding my mean, and then finding the absolute number of that mean, and then adding it together, I have arrived at this formula. But at least the process is easy to follow. The process is actually easier, it's simple. But when you try to look at it from the point of this formula with the way it is written, if you're not very conversant with economic formula, financial formulas, and all, it might look a bit overwhelming. So my advice is, when you get into these deep places, use example. When you see the formula, it's fine, you can write it down, but walk through the example and see how they follow it step by step. The example would always show you how the formula is put together and how you arrive at your answer. Always, it will always show you. And the formula is always just provided so that it can guide you, maybe something you can remember. But if what you can remember is the steps, then that is even better. And so that's why I introduced this one here, just to show you how typically you deal it. Now, we've talked about the range, we've talked about the mean absolute deviation. Now let's talk a bit about the variance. Now, variance and standard deviation is one concept you would work with, I mean, very, very well, both in level 1 and even up to level 3 and beyond. So it's important that you have a very solid foundation of what variance is and what standard deviation is. The first thing is, standard deviation is the square root of variance. So the difference between variance and standard deviation is that you just find the square root. So if you get your variance, all you need to do is just find the square root of that number and you get to standard deviation. Now, why do you need to find standard deviation? You may not find this in your earlier curriculum, but when you go ahead, you'll find it. It's because whenever you're doing any calculation, your standard deviation is always in the same unit with your returns. So it is comparable. So if your return is in percentage, or it's in value, or if it's in number, or if it's in, any whatever, once you find the standard deviation, it puts you back into that unit level. Therefore, it is comparable. And that's why standard deviation is a very powerful tool. But how do you find variance? Let me step back a bit to the mean absolute deviation. Recall that we talked about dispersion, and we said that dispersion is variability around central tendency. Now, go to this formula for mean absolute dispersion. What is the central tendency here? The central tendency is the mean. So you can see in this formula that everything is in relation to the mean, which means we picked each of the observation and we relate it to the mean. We compared it to the mean. And that's what dispersion really is. Every dispersion has a central tendency, which means it is related to a central tendency. And the central tendency that is used or mostly used is the mean. And therefore, you will see that in this formula, we use the mean here. Now, in the variance as well, you can also see the value of the mean also shown here. Now, the key difference between the variance and the mean absolute deviation is that rather than find the absolute number of the difference or the deviation from the mean, right? Rather than find the absolute number, we found the square root. Now, these are some of the languages you should get familiar with going forward. Number one, when you take your observation and you subtract your mean from it, what you are calculating is called deviation from the mean. So when you look at the steps here, the first thing to do is to calculate your sample mean. That is, calculate your central tendency, or calculate whatever you're using as a measure of your central tendency. In this case, it's your mean. Then the second thing is to calculate what we call the deviation from the sample mean. Deviation from the sample mean is to take each observation and then you find it, and then you subtract your mean, your calculated mean from it. What you get is called the deviation. Now, when you then square that number, it's called squared deviation. The reason why I'm putting it this way is when you get into the curriculum and when you get into the nitty-gritty of QM, you'll start seeing these words being used. They won't break it down this way anymore. They will start saying squared deviation. They will start saying deviation. And so how do you know what they are talking about when they say squared deviation? And they might say squared deviation and they put one ugly looking formula like, what's this one now? When you understand this build up, you understand that what they are simply doing is really breaking down this formula so that they can get an answer. And it's as simple as that. So when you take each observation and you deduct your mean from it, what you're calculating is called the deviation from the sample mean. When you square that number, what you're calculating is called squared deviation. Now, the reason why you see n minus 1 here at the denominator, typically this formula should stop at the top, at the numerator. But the reason why you see the n minus 1 here is because we are dealing with a sample. Whenever we are dealing with a sample, we must always use n minus 1. What is a sample and what is a population? We'll see that a bit. So you may just hold that thought, and we will see how to properly define population and the sample here. So what you would then notice in this step is, if you go back to step 1, it says calculate the sample mean. Now, for QM, it's always important to look at the language used. It tells you what you're dealing with. The first step already tells you calculate sample mean. What this tells you is that everything you're dealing with here is a sample. Now, because if you're dealing with a population, you will not need to put the n minus 1 under. But when you're dealing with a sample, you must put the n minus 1, that denominator factor. But how do you know you are dealing with a sample? It will tell you sample mean. The moment you see calculate sample mean, it tells you that the data you're working with is a sample. It's not the population. And so when you square that, you add it all together. And that is why you see that in step 4, you sum the sum of squared deviation, meaning you found the deviation, you squared the deviation, and then you sum all of the squares together. And that is called the sum of squared deviation. The reason why, again, I'm breaking it down this way is when you get into the study, what will be said, what will be written or said will be sum of squared deviation. And then they will put this formula behind it. But when you understand how the build-up starts from 1, 2, 3, 4, you realize that it's really not a big deal. And then step 5 is for you to divide the sum of squared deviation from the mean by n minus 1. Again, the reason why we are doing this is because it's a sample. And like I mentioned earlier, the next step to finding square root is to find the square root of that number. And when you find the square root of that number, what you end up with is called the standard deviation. Now, what is the difference between population and sample? In your level 1 curriculum, there is a particular module that is dedicated to sampling and estimation. And it talks about how to draw sample. Now, what is the key difference here? Population is the entire data point. It is the entire data point. If you have data for 100 years and you have all of the 100 years and that's what you want to use, and that's what there is, then what you're dealing with is a population, which means you have everything. For example, if we are to calculate this for a population, for example, what we'll be calculating here is step 1 will be calculate the mean, not the sample mean. And then by the time we get to step 5 and 6, we will not need to put the n minus 1 in the denominator. So from the population, you can then draw your sample. So you can see that out of this large number of people, this blue lady was drawn, this black guy was drawn, the brown guy was done, the gray man was drawn, the black man was also drawn. Now, these 5 of them represent the sample from this population. It represents the sample from the population, which means they were drawn from this population. Now, a statistic is a summary measure of a set of observations, and descriptive statistics summarizes the central tendency and spread variation in the distribution of data. Put in another way, a statistic is a number or a calculation that describe a particular population or a particular data distribution. It's called a statistic. Now, when the statistics is based on population, it's called a parameter, which means if I calculate, I'll give an example of a statistics is mean. Now, let's say that there are 30 people in a room, right? If there are 30 people in a room and I try to look for the average age. So it means that I will get the age of all of them, what I will add it together, then I will divide it by the total number of people in that room, which will be 30. What I get using this process is the mean, that is the mean age. Let's say that mean age is 29. What I'm saying is that 29 is called a parameter. It's called a parameter because it's a statistics, but the statistics is based on the entire population of 30 people. Therefore, it's called a parameter. Now, look at it in another way. If I then look at that class and then select 10 people out of that class, and then find the age of those 10 people and then divide it by 10, right? Let's say I find the age of the 10 people and then divide by 10 and I get 26, right? Then the 26 is the mean age of the 10, that is of the sample. Now, that mean that I've calculated is not going to be called a parameter. It's going to be called a sample statistics because it is based on sample. And typically in QM, we just remove the sample and call it statistics. And so it is important to understand that both parameter and statistics are statistics. But when you call it statistics, it means it is based on samples. When you call it parameter, it means it is population. Now, why is this important? I've mentioned earlier there are key to questions. And CFA expects you to understand this nitty-gritty, which means questions could be set and they will put parameter there. And they may not say anything else to show you if it's a population or a sample. The fact that they use the word parameter already tells you that you are dealing with a population. If they use the word sample, it tells you that you are dealing with a sample, a statistic rather. It tells you that you are dealing with a sample. So those are some of the keys, both in how words are described, both in how questions are, built up, to tell you or to give you a key as to what it's being required or what is being asked, of you. And so we talked about measure of central tendencies earlier. Perhaps it's the way I arranged this, where we talked about mean, median, mode. Now, mean, median, mode is perhaps the most used measure of central tendency that we have. And so we'll look at it. It is also the most used, is the easiest to calculate. And so let's just take a bit and look at it. Now, arithmetic mean is the sum of all the values of the observation divided by the number of observation. I want to take it for granted that a lot of us already know what the mean is. But essentially what it means is that you look at each of the observation, you add it together, and you divide it by the total number of observation. So the value of the observation, you add it and divide by the number of observation. Now, when we look at the table on the right, let's take year 1, for example. If I need to calculate the mean of the weekly return in year 1, what I will do is I will add minus 15.6 to 7.8 to 5.3 and all the way to 11.5. And then whatever that value gives me, I'm going to divide it by 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. I'm going to divide it by 11. And whatever I get is called the arithmetic mean. The arithmetic mean really is can be related to a what we call a fulcrum. What is a fulcrum in physics? And some of us that we're familiar with physics, we would understand that fulcrum is like the center point or the balancing point of an array. And what does that mean? You could have 10 data points with different values. It does not mean that the center point will be at 5, right? Because the observation, the absolute observation for each of the of the data point might actually be different. Now, if you look at the exhibit 34 here, for 2, you can see how small it is. For 12, you can see how big it is. When you add the 12 to 10, it actually counterbalances 6, 4, and 2, right? If you add all of this together, it counterbalances there. And the point at which it counterbalances is at 8, not necessarily at 5 or not necessarily at 6. And that's what mean is. What that means is that I could have a number between 1 and 10. I can add it together. My midpoint might not necessarily be 5. My midpoint can actually be 8, depending on how if I have outliers, what we call outliers in that data, right? And so that's what arithmetic mean is. We also have what we call the median. The median essentially is the midpoint value of any item. While you are not required to sort the mean, you are required to sort the median. That is, you can calculate your mean without necessarily sorting the data in ascending or descending order. But for you to calculate the median, you must sort it. You must sort the data in either the ascending or the descending in a descending manner, and then you pinpoint the middle. If it's odd, then you then have to add the 2. If it's if it's odd number, you can then add the 2 numbers in the middle in the middle position, or if it's even rather, you add the 2 numbers in the middle position and divide by 2, and whatever you get is your median. So remember that the reason why we are doing all of this is that we are trying to figure out what value represent our midpoint. This is all about central tendency. So we're saying that if we can pinpoint the number that is at the middle, the median, we can rely on it and call it the central. That is the number in the middle, the average, the median. Or we calculate the mean. Whatever that average is, we can take it as the middle number. That's what central tendency mean, and that's why we're doing median, mode, and mean. And the last one really is the mode. Mode is the most frequently occurring value in a distribution. The assumption is that here is that the number that occurs the most frequently is likely going to be like, the average number or the middle number there. So what that means that in all of the calculation we've done, in the dispersion calculation we've done, the implication of this is that the way we used mean is the way we could have used median, or the way we could have used mode. So if you had used median to calculate your MAD or to calculate your variance, for example, you wouldn't be wrong. Or if you had used mode to calculate it, you wouldn't be wrong. Now, the reason why we don't use median and mode is that we found that mean happens to be the most efficient of the central tendencies. So it's not by accident. By central tendencies mean you could have used median, you could have used mode, but the reason why we don't use it is because the mean is the most efficient of those 3, right? And even when we talk about efficiency, you still also see that there are other means that are much more efficient than the arithmetic mean that we talked about. Now, when we talk about the mode is the most frequently occurring value, and we could have what we call a unimodal. Unimodal means there is just one mode. Bimodal means 2 modes. Trimodal means 3 modes. What do we mean by one mode? One mode means that there is a particular observation that has the highest number. We can tell, we know that it is this one. Bimodal means that there are 2 observations that has equal number of high observation. Therefore, both of them are modes. That's what bimodal means. Trimodal means that there are 3 of them. They have the highest number of observation and they are the same. So you can't say, you can't tell them apart, and there are 3 of them. So that's what trimodal is. And in the image to the right, It's its daily return range and also the number of observation. And you can see that the modal here is return of between 0 and 9. That is where we have the highest number of observation. That is for the period under or under survey or under investigate or under review. We had the most we had returns of between 0 to 9% the most time, and therefore that is the modal return range. There are other ways in which we calculate mean. So we've looked at the arithmetic mean, but the arithmetic mean is not the only way in which we calculate. It's not the only way we calculate mean. We also have what we call the weighted mean. The weighted mean has application in investment. In fact, you will hardly use the arithmetic mean in investment because clearly of the obvious flaws that it has. You will likely have to use either the weighted mean, the geometric mean, the harmonic mean. These three other type of mean have their benefits, they have their advantages. Now let's look at the application of the weighted mean. In the weighted mean, it considers the weight. It considers the weight of each element in the calculation. It considers the weight of each element in the calculation. Now, let's take a portfolio. Now, let's say that this is a portfolio. Let's look at this example. Using the country index data in Exhibit 33. Consider a portfolio that consists of 3 funds that track 3 countries' indices, country C, country G, and country K. The portfolio weights and index returns as follows. So you can see that in country C, this portfolio allocates 25% to country C, 45% to country G, and 30% to country K. Now, use the information provided to calculate the returns of the portfolio in each year. So for each year, how do you calculate the return? Now, because the portfolio is divided into 3 and some allocation in country C, some in K, if you just do a flat arithmetic calculation, you would be wrong. An arithmetic calculation in this case will be 5.3 plus 12.7 plus 11.5 divided by 3. And you will get the arithmetic calculation, but that would be wrong. And how do you know that that is wrong? This is a portfolio, which means you invested these funds, and clearly, when you value the portfolio at the end of the period, you will see the value. The value you will get if you do an arithmetic return calculation will be different from the actual value you will get. What will get you close to the actual value you get is if you do a weighted mean. That is, you look at the allocation you have in country C and you multiply it by the return you had in country C, right? You look at the allocation you had in country G and you multiply that with your return from country G. You look at the allocation you had in country K and then you multiply by the return in country K. Therefore, to calculate this, you will have 25% times 5.3 plus 45% times 12.7 plus 30% times 11.5, and then you add all of that together to get your actual return. And when you use that return and you put it over the actual value invested, you will realize that it is closer, very close to the actual value of return that you have. Again, at this point, I would also just I will just pause and also take questions if there are if there are any. Let me check if there are questions in the. Yes, thanks, Timothy. Thanks. Are there questions? I can't see any question. I can't see questions here, so I'll take that as perhaps we can continue. Okay. All right. I'll just continue. Again, you can drop your questions if you do have, or we still have some time to take question at the end of the period. Okay. So there are other types of mean that we have. Apart from the weighted mean, we have what we call the geometric mean. The geometric mean is very useful for calculating return over multi-period. Actually, so when you're calculating return for multi-periods, then you are interested in how it grew. The investment grew over time. So it's important that you are able to link return from one period to the other. And the way to do that is to use what we call the geometric mean. However, the geometric mean does not permit negative value. And therefore, the way to adjust for that is to add every return to 1, right? And by adding it to 1, you automatically convert all of those returns to non-negative. Now, questions might come to say, to check if you're understanding if you can use negative return or if you can calculate geometric mean with negative return. You cannot, but for you to calculate it, you have to first convert it to non-negative for you to use it. If not, the data or the result you get will be nonsensical. It will not be very meaningful. And so the way to do that is that you add 1 to every return you get. Now, let's say you get a negative return. Let's say I get a minus 15% return. By the time I add 1 to it, that minus 15 becomes plus 85, 0.85. Therefore, it has automatically converted to positive. If I generated 15% positive, if I add 100%, it becomes 115, which is still positive. So by adding 100% to all, or by adding 1 to all of the returns, it automatically flips the return to a positive, which means you can't get a negative return. And then you can then go ahead with your calculation. And the way to do that is you chain link your returns, and then you deduct 1 from, you chain link your return, you find the end root, and then you deduct 1 from it. I intentionally, I didn't go through the detail here. In the actual class, really, or you could do that in detail. Again, also just to mention, there are key concepts here that requires much more time to build up. So I'm also careful not to try to water it down, even though we say, oh, this is simple and it's easy to understand. There are some of them that are that are as complex as it is. And the right way to learn them will be to build the foundation properly. It's not something I can it's not something I can rush through for the sake of time. We also have what we call the harmonic mean. The harmonic mean is useful when what you're looking at or the data you're looking at is already a rate of change. It's already a rate of change. It's not an absolute number. It's a rate of change. When you're looking at a rate of change, which means what you're looking at on its own is already a rate, then the harmonic mean is really the best to use as compared to the geometric mean and the arithmetic mean. The geometric mean is best used for cost averaging, where you want to find the average, of two values. Now, the way this is structured, or the insight that you can get from arithmetic, geometric, and harmonic mean is that the harmonic mean is always lesser than the geometric mean. The geometric mean is always lesser than the arithmetic mean. The arithmetic mean is always the highest. And again, you could get a list of numbers, a list of values, and then you get and they'll tell you that the arithmetic mean is X. Let's say that the arithmetic mean is 15.5. And then they would then give you 3 options. Which one is the harmonic mean? Clearly, whatever your option is, you know it cannot be higher than the arithmetic mean. So you can, at the top of your mind, just eliminate any number that is higher than higher than the arithmetic mean. Now, and that's what I meant when I said you could be given a calculation number that does not require calculation. So when you understand the relationship between all of these, geometric mean, harmonic mean, and all of that, you can actually answer your question. What CFA level 1 expects you to do is to understand those relationships and be very clear about those relationships, because those relationships are quite constant. They really don't change. It means that you can apply it anywhere and it will still give you a very consistent answer. So that is one of the critical things that they try to look for here. I won't dwell so much on this. This is the calculation of variance and standard deviation. I think we've covered that very well. And so now, I'll now just talk very briefly about probability. Now, there are two modules on probability that is part of this prerequisite reading. My advice is that you take it seriously. Of course, take the whole prerequisite reading seriously. However, for the probability is tied to a lot of the stuff you would do in later in QM, and you will see how that play out. But also you will see a lot of application in it when you begin to look at options and option pricing. What this probability has done is to give you a foundation for arriving at certain numbers. And you would also see how it is related or relevant to some of the real life questions that we also ask, perhaps that we ask ourselves on a daily basis, and how we then make sense of it. Now, what is a random variable? A random variable is a quantity whose future outcome is uncertain. Uncertain. What is uncertainty? Uncertainty is something that we do not know, but we can measure. So there's a level of measurement that comes with it. Now, because if you cannot measure it, you can't really put it in a quantitative format that would enable you to put it into a probability. Probability really requires you to be able to put in some numbers to it. Now, understanding this foundation, or why this question comes up, would then form a basis for you understanding when you get later into what we call the base formula, how the base formula is set up and all of that. Now, when you understand that the basis for a random variable is that there is uncertainty, right? What that tells you immediately, or you can begin to infer from that, is what if you do know something for certain? Then you can't say it's random. Because if I know, for example, that something would happen tomorrow, it is no longer random. It is very predictable. Anyone can predict it. There is no magic, or there is no mechanics to predicting anything anymore. I can only be talking about predicting something if there is uncertainty in it. And so probability becomes useful only if you have uncertainty. If there is certainty, then probability is really not useful. Why? Because if I know that something is going to happen tomorrow, the probability is then 100%. The probability that is going to happen tomorrow is 100%. If I know something is not going to happen, then the probability is 0%, which means there is no element of uncertainty there. It is certain. It is certain that it's not going to happen, or it is certain that it is going to happen. So uncertainty, or probability, is about uncertainty, and it's about random variable. And random variable is random because there is uncertainty about future outcomes. An outcome is possible value of a random variable. So it could either, so tomorrow, for example, I don't know, not looked at the weather forecast. It could rain tomorrow, or it might not rain. If it rains tomorrow, it's a possible outcome, right, of a random variable. Random variable is what can happen tomorrow. If it rains tomorrow, that is an outcome, a possible outcome of a random variable for tomorrow. If it does not rain, it's also a possible outcome of a random variable. So it means that tomorrow it can either rain or not rain. And an event is a specified set of outcomes. So if tomorrow it rains, or let me put it this way, tomorrow there are two events that can happen, which are sets of outcomes, right? That is, it could either rain or not rain. When I combine my rain and not rain together, I get an event, because it's always word and opposite. If it rains, then it means it cannot not rain. Because if one happens, then you already automatically know what the other is. But today we don't know. Therefore, we are assign probability to it. So, for example, I could say, oh, there's a probability that there's a 60% chance or probability that it will rain tomorrow. What I'm also saying implicitly is that there's a 40% chance that it is not going to rain tomorrow. So when I put my probability of raining and probability of not raining together, I have an event. So that's what it means. And so there are two defining properties of probability. The first one is probability of any event E is the number between 0 and 1. 0 meaning there is absolutely no chance for it to happen. That is, I know it is not going to happen. Then the probability is 0. Now, I wanted, if I use football now, some of you can start a fight on this call. So let's not use football. Let's use something else. Okay, let's use day of the week. Tomorrow, there's no chance that tomorrow is a Saturday. There's no chance. So I cannot say, oh, there's a probability for tomorrow being Saturday or probability for tomorrow being Monday. It's not a probability. Why? Tomorrow is clearly Monday. The probability that tomorrow is Monday is 100% because it is known for a fact. The probability that tomorrow is not Saturday is known for a fact because tomorrow cannot be Saturday. Therefore, the probability that tomorrow is Saturday is 0. The probability that tomorrow is Monday is 1. Then everything falls in between that spectrum. And that everything within that spectrum is defined or decided or determined by the uncertainty, which means uncertainty can then make it take any value between 0 and 1. But you see those two bounding values, they are not uncertainty focused. 0 is not based on uncertainty, it's actually based on certainty. 1 is not based on uncertainty, it's actually based on certainty. But everything in between is based on uncertainty, right? So that is the first defining property of probability. The second defining property of probability is that any set of the sum of probability of any set of mutually exclusive and exhaustive event equals 1. So at this point, it is important to explain what mutually exclusive is. Mutually exclusive means that if one happens, then the other cannot happen. It's mutually exclusive. It's either you eat your cake or when you eat it, you can't have it. Or you still have it and you've not eaten it. You can't eat your cake and have it back in probability. It's not possible. A good way to look at it is to say that if it rains tomorrow, then there's no chance that it did not rain. So the fact that one has happened clearly means that the other did not happen. I cannot have a situation where it rained and it did not rain. So if it did not rain, then it couldn't have rained. That is what we mean by mutually exclusive. If an event happens, then it means that the other event did not happen. Mutually exclusive. You can't have both events happen at the same time. The second is exhaustive. Every possible outcome or every possible event must be captured. Every possible event must be captured. Now, take example of tomorrow. There are two sets of events that can happen tomorrow as far as raining is concerned. It can either rain or not rain. There is no third option. There's nothing in between, right? So if I get into tomorrow and it's cloudy and all of that, but it didn't rain, well, it still didn't rain. If it rained, then it rained. But there's no other third option. I can't get into tomorrow and there's something else that is not included in rain or not included in not rain. And that's what we mean by exhaustive. All of the events are exhaustive. Everything that could possibly happen has been factored in. That's what exhaustive means. Now let's use financial terms, right? The stock price of a particular company on a particular trading day can have three events, three exhaustive events. Number one, it can go up. Number two, it can go down. Number three, it can stay flat. Those are the three events. There's nothing else outside of those three events, which means those three events describe the exhaustive nature of the events that can happen to that stock price. That's what it means. Because if I then get to tomorrow and then look at the stock price of look at the price of that stock, it's either it has gone up or it has gone down or it remained where it remained in a place. And therefore, when you add all of the mutually exclusive and exhaustive events together, it must equal 1, which means the probability of the stock going up plus the probability of the stock remaining the same plus the probability of the stock going down must always be equal to 1, must always be equal to 100. Those are the two defining probabilities of the two designing properties rather of probability. Again, probabilities can be stated as odd. And then perhaps some of us who are familiar with betting might perhaps be able to speak to this more, because they talk about the odd for something, the odd for something, the odd for something. When we say the odds for something, what do we really mean? When perhaps in betting and all of that, and say, the odds of something happening, or the odds of, what does it mean and how does it relate to probability? How does it relate to probability? The way it relates to probability is that, number one, the odds for something, the odds for E being an event, the odds for E are the probability of E divided by 1 minus the probability of E. So given the odds for E of A to B, the implied probability of E therefore is A over A plus B. You can use odd to find probability. You can use probability to find odd. That's what this is. So let's use, and I said earlier, sometimes when you use, when you look at this formula, it might look all over the place. But when you look at an example, it probably might just put much more clarity to it. So let's look at the odds of passing a QM method investment course. Now, two of your colleagues are taking a quantitative method investment course. If your first colleague has a 0.4 probability of passing, so the probability of an event, that is probability of passing, is stated, what are his odds of passing? So you see here, you can have the probability of something, of an event, and you can have the odd of that event. So what has been stated here is the probability of passing. Now, what the question is asking for is the odds for passing. Now, the odds for passing, remember, is the probability of passing over 1 minus the probability of passing. We've been told that the probability of passing is 0.4. Now, what is 1 minus 0.4? That is 0.6. Therefore, the odds for passing is 0.4 divided by 0.6, which is 2 over 3, which is 0.667. Clearly, therefore, the odds for passing is 0.66. You would realize that this is different from 0.60, which is the probability of not passing. So it's not just enough to take the probability of passing and just deduct it, do 1 minus and say that is the odd. You have to calculate it, and the way to calculate it is to go through this short process. Now, if your second colleague has odds of passing of 4 to 1, now what is given here is the odds. The question then says, what is the probability of her passing? In the first question, we were given the probability, we were to calculate the odds. Now, we're given the odds, we're to calculate the probability. Now, the probability for passing is the odds over 1 plus the odd, or say 1 plus, no. So the odd is stated as to 1, odd of something. is always stated as odd of something to 1. Now, when you're calculating it, you take that odd and then you divide it by the sum of that odd and to whatever it is. And that's what has been done here. So in this case, A is the odd that has been given. 1 plus 4 is the odd 2. So the odds of 4 to 1. So you add the 4 to 1 to get 5, and that becomes the denominator. That applies when you're looking for the probability. When you are looking for the odd, you use the first formula, or what we did in question 1. When you're looking for the probability, you use what the formula we have in question 2. So okay, I think that's it for the notes. I'll just I'll pause here to take any question before we continue. Okay, do we have any question yet? Now at this point, I'll just for the remaining minutes left, I would just take us through hypothesis testing, estimation, which is one of the areas that candidates typically also kind of find challenging. Now, the basics for sampling and estimation, I would switch and go to the reading material and look at those two topics there. Now, the basis for sampling and estimation really is founded in the fact that in most cases, you cannot observe the population. It's difficult to observe the population. Now, I gave an example earlier in the day where we looked at we looked at the example of the population of Nigeria. It's impossible, practically impossible, to know the number of human beings of Nigerian descent, right, that live in this country. I mean, not to the accurate figure. So we could have an idea of what it is, but not to the last digits. That's what we're saying. And as long as you cannot use that accurate, you cannot get to know that accurate figure, then clearly it means that whatever you're doing is clearly going to be based on an estimate. Now let's look at other examples. Let's say I want to know the prices of Gari in Nigeria. Gari is one of the staple foods, right? Now, when you see in the newspaper or when you see in the MBS data, where they say, oh, the price of one basket of Gari is, say, 6,000 or 5,000 now. Did they go to all of the markets all over Nigeria to get the price of Gari? The answer is no. Not only would they not have the time to do that, even if they could access all of the markets, I'm sure they don't even know all of the markets that exist in Nigeria, every nook and cranny of Nigeria, right? So how did they arrive? How did they arrive at 5,000 naira as the price of Gari? What they did is that they drew samples. And how did they draw that sample? It means that they could go to Lagos market, for example, select 3 markets in Lagos. Let's say they select Oyibo market, Shasha market, and maybe any market in mainland, and they send people there. And when they send people there, those will ask for the price of Gari from stores. Remember that if you go to an Oyibo market, for example, there are perhaps more than 1,000 people selling Gari in that market, depending on how big that market is. Did they ask each of those stores for the price of Gari? The answer to that is also no, which means, I mean, they might not even be able to walk around the whole length and breadth of that market to identify everyone who sells Gari and then ask them for the price of Gari. It's practically impossible. So what do they do? Or what is done in real life? What is done in real life is that samples are taken, and we looked at the examples of how we draw samples earlier, a very basic example. There are other ways in which samples are drawn. You will see that in your expanded curriculum, right? Now, so what is done is that samples are drawn, and then we then calculate statistics based on that sample. And when we calculate statistics based on that sample, remember the conversation we had about sample statistics and parameter. If it is not based on your population, then it's sample statistics or statistics. Then they calculate statistics based on those samples, and whatever they come up with, they must take it through one other test, right? Before you can then rely on them. That test is called hypothesis testing. Now, hypothesis testing does not necessarily mean, the way I have set it up. It could mean that you already have an existing data, or you already have an existing position and you just want to test. But when you're testing hypothesis, what really are you doing? What exactly are you doing in hypothesis testing? I'm saying that this parameter, this sample parameter, right, is it likely to have been drawn from the actual population? So let me use an example to explain this. And let me use the example of the class of 30 people. Now, there are 30 people in a class. Now, I found the average age, and let's say it's 29. Now, I know that I sampled I know that I found the age of everyone in that class, the 30 people in that class, right? Now, but when I drew the sample of 10, I found the average age of 26. Now, you could say that, oh, 26 is clearly different from 30. But that's not the question that hypothesis testing is answering. Hypothesis testing is not trying to answer if 26 is different from 30. Hypothesis testing is trying to answer the sample that generated 26. Is it likely that it is drawn from the sample from the population that generated 29? That's what hypothesis testing is saying. And whatever the answer is, will then tell you how confident you should be, in saying that, yes, even though my answer is 26, I'm sure that the population that generated it is the population of 29. Therefore, I can rely on the 26 and use it. I can rely on it that it is correct. I can rely on it that it is a representation of the true population parameter. That's what it means. And that is what hypothesis testing does. That's what we do it. So the reason why we do hypothesis testing is because we use estimate, we use sample. And as long as we use sample, we cannot be certain. There will always be a level of uncertainty in whatever outcome we have. And the reason why that level of uncertainty will be there is because we did not observe the actual population. Now, what that also means is as long as I'm not using the entire population, then whatever I'm going to get is already prone to some errors. And that is why you see that in hypothesis testing, there's always that discussion on of errors, standard error, errors of estimates, and all of that. And you will see all of that when you go into the nitty-gritty of hypothesis testing. So this is just to provide you a kind of overview to say, why do we do hypothesis testing? One, we do it because we cannot observe the population. Therefore, we have to use samples. Now, how do we select the samples that we use? We use what we call the sampling method. How do we systematically or scientifically determine that or draw a sample from a particular population that is there? Then after we've drawn the population and after we've calculated the statistics from that population, can we rely on it? Can we rely on that population? Can we say that the outcome is a true representation of the true population, right? That is what hypothesis testing really deals with. Now, hypothesis testing hypothesis testing follows you know specified steps, right? Now, part of this test, let me just I'll stop sharing and then reshare back. I want to switch back to that portion in the curriculum so that we can also follow visually. Just a moment. Okay, I can see some question. I saw the question on can we have some practice question in the area we covered? Yes, clearly yes. If time permits, or what I can also do is perhaps by the time we get to maybe 3:30 in the next 15-20 minutes or 3:40, we'll just stop and then we'll look at one or two questions in the area that we have. It's also important. We've talked about so many areas. You can also just point me in the direction where you would want us to focus question. We've talked about a lot today. And there are so many questions clearly on that. So it would be good if you can just point to the specific area and we can just look at questions there. So let me know. You can just put in the Q&A and the area you want us to look at, and we'll look at. I'll create some time. I'll leave some time for questions at the end. Okay, I'm resharing my screen now, and let me know when you can see it. Yeah, the whole thing. Please. Okay. Okay. Can you see my screen?
Yes, sir.
All right, great. Thanks. All right. Now, so I've talked about the main reason for hypothesis testing, and the process of hypothesis testing is perhaps that's where we would just conclude today. Before we talk about the process of hypothesis testing, there is an important theory from probability called the central limit theorem, or normal distribution. There are different distribution and probability distribution, but there's one called the normal distribution. Now, the normal distribution, we call it normal distribution because it's an outcome. And the reason why we do hypothesis testing, the reason why we even do sampling is because of central limit theorem and hypothesis and what's it called now? Normal distribution. What do we mean? If I have 1,000 data, right, and I draw sample from that data, and I plot the mean of that of the outcome of those samples, what I will end up with is a normal distribution. A normal distribution is bell-shaped. And if it is true that what I will get is a normal distribution, it means that central limit theorems hold. If central limit theorems hold, it means I can rely on the parameter to make a decision about my population. That is, I can rely on the estimate or the statistic to make a decision on my population. Let me rephrase that. The reason why we could use estimate is because of normal distribution. And what it means is that if I have 1,000 data, right, which from that data, I then select samples. Let's say I select sample of 50-50. And then I select the first 50, I find the mean. Select the second sample, I find mean. The third sample, find the mean. And let's say I do this 100 times, which means I will have 100 new means calculated each time. If I plot that new mean, right, if I plot it, I will end up with a normal distribution. That is, there was going to be a concentration of the highest number somewhere in the middle. And then the other will just thin out by the side. I will end up with a normal distribution. And because of that normal distribution, we say that the central limit theorems hold. Implication of that is you can describe any data if you know the mean and the variance. That's the implication. So you will then realize that in hypothesis testing, all that we use is mean and variance. Mean and variance is all that is used in hypothesis testing. The reason why we use mean and variance in hypothesis testing is because the central limit theorems hold. Now, I just went back through this, you take a step back so that so that you can perhaps see the transition between probability and hypothesis testing. The way it is arranged in the test, you have to do probability first before you come to hypothesis testing, right? And the reason why it is arranged that way is not because you are going to use probability per se, even though you still do some form of probability in hypothesis testing, is because the foundation for hypothesis testing really is on probability distribution, the normal distribution for to be specific. And so when we're conducting hypothesis testing, there are 6 steps to follow. The first step is actually to state the hypothesis. Now, what do we mean by a hypothesis? Hypothesis is a postulation or a position, right? And that position is always about the population. Hypothesis testing is all about population, not about sample. It's all about population. Because what you're doing is that you have your sample. So say I have this sample, but how sure am I that this sample could have come from the population? If I am sure that it came from the population, then I'm fine. I can use it. Therefore, hypothesis testing is always in relation to your population. Therefore, when you look at where hypothesis testing is structured, right, it's always in relation to population, always in relation to population. And therefore, there are 6 steps. The first one is the hypothesis. Your hypothesis is essentially your position. Then the next step is to identify the appropriate test statistics. I would go through it in a bit more detail. What do we mean by the test statistics? The test statistics is the measurement criteria. Now, it's like you saying that I want to measure how long it takes for something to happen. How do you want to measure it? What tool do you want to use to measure it? I would say time. It means I have to have a timing device, and then I can clock in the time the event starts and clock in the time it stops, which means I will have described from the beginning the appropriate tool I will use to measure. And that is what the test statistics means. There are different test statistics depending on the type of measurement or testing that you're doing. And we'll see those test statistics, the appropriate ones, shortly. You will also specify the level of significance. Now, the level of significance is how confident you want to be with your test. And this is very important. What that means is that you do not just conduct tests as open-ended, because when you conduct it as open-ended, the result is not very meaningful. Okay, for example, if I say, how confident am I that what is the likelihood that this sample is from this population, right, or is from a population X? It can throw me any number, but when I say that I want to be 100% sure, then the analysis is automatically adjusted to give me a result that is very sure that this is from the population. And therefore, if it is not very sure that it's from the population, it's going to show in my result. So how sure I want to be is called the level of significance, right? And we'll see that level of significance is always expressed in some form of probability, right? Typically, it's set at a baseline of 5%, but it could be any number. The 5% is just, it's just an easy place to start, typically. Then you state the decision rule. And you state the decision rule from the beginning to say, if this is this, then this is the decision I will make. And the test statistics, different test statistics has different decision rules. Therefore, you will need to study the test statistics and then the decision rules for the test statistics. Then the next thing is that you collect your data and then you calculate the test statistics. Now, in calculating the data and in collecting and calculating the data, remember that only 2 things you're required, the mean and the variance. The hypothesis testing is always based on the mean and the variance because of what we talked about earlier. And then you make your decision, which is the final steps. But what you will realize is that by the time you get to 0.6, you can no longer change the parameter, which means by step 2, you already state which test statistics you're using. By step 3, you already state how confident you want to be. By step 4, you already state what your decision rule. By the time you do your calculation in step 5, you're clear about the decision, which means you already said that if it is at this level, this is the decision I'm going to make. That decision rule is set. You already said that you want to be this sure. So whatever result you're getting is based on that level of significance. In number 2, you already state the test statistics that you're using. And that is, the result is going to be interpreted in line with that test statistics. And then you make your decision in step 6. Now, looking at it in a bit more detail, stating the hypothesis, which is the first step, right? There are 2 types of hypotheses that must be stated. The first one is called the null hypothesis and the alternative hypothesis. I mean, I don't know why I'm talking about this. I'm sure everyone on this call, you probably know what I'm talking about because you must have done some form of final year project, right? And in that project, you will recall that you did what you call null hypothesis or an alternative hypothesis. Even though it's that we all understand as at the time we did it, what null hypothesis and alternative hypothesis truly mean. But what is null hypothesis and what is alternative hypothesis? Alternative hypothesis is where you want to be. Where you want to be. Your null hypothesis is what you want to reject. Now, let me put it this way. Let's say you are a scientist. And you're working on a new vaccine that is effective against malaria, right? Then you've created the vaccine, and let's say you have administered it to a set of people with a placebo and then with the actual vaccine, and then you've collated the data, right? Now, at the end of the day, what you want to achieve, right, is that it works. Which means what you want to achieve is that this vaccine is effective without any side effect. That is where you want to be. If you get that result, then you can go and publish your paper and you'll be happy and you might get a Nobel Prize. So that is your alternative hypothesis, actually, because that is the result you want to get. Your null hypothesis, therefore, is that all those things, it does not work. So your null hypothesis actually looks for evidence against your position. It's a strong evidence against your position, which means you stand on a position, then you go and look for evidence against it. And it's structured this way because if you stand in a position and you are looking for evidence to support your position, you're already biased, which means you stand in a position, then you go and look for evidence to negate your position, right? And that evidence to negate your position is called the null hypothesis. The alternative hypothesis is only structured to be where you want to be. Now, in setting up a hypothesis, there are 2 types of hypotheses that could be structured, that could be set. We have the one-sided, and then we have the two-sided. By one-sided, we're saying, let me start with the two-sided. Why do we call it a two-sided hypothesis? It is a two-sided hypothesis because there are possibilities on both sides, right? Now, let me take, for example, if I say that the return for a particular year equals 6. The moment I say that the return for a particular year equals 6, I have set up a two-sided hypothesis. What do I mean? If I say that it is equal 6, right, it means that as long as it is not equal 6, right, then it's less than 6 rather, I'm not correct. If it's more than 6, I'm also not correct. Which means there is a possibility of the possibility of outcome below 6 and above 6. And that's what two-sided means. So the moment you set any hypothesis with an equal to sign, you're setting up a two-sided hypothesis test. As long as you put equal to, because you would then have options or outcomes that are lower or higher than that number. Now, how do you set a one-sided hypothesis? A one-sided hypothesis is simply set at equal to, greater than, or less than. Now, when I say that my position is odd, but that the return is less or equal to 6, what I'm saying is that anything above 6 already falls into the other position, because anything below 6 up to 6 falls within my position. Anything above that falls outside my position. So I have one side locked down, right? And that's what a one-sided hypothesis means. A two-sided means you can have options on both sides, or you can have outcomes to both sides. So that's for one-sided and two-sided hypothesis. Why would you set a one-sided and two-sided hypothesis? One-sided hypothesis actually it reflects your belief about a particular position. It reflects more your belief about a particular position. For example, if you say everything higher than 6, I mean, that is a wide range, but you must be very, very convinced for you to choose that wide range. And that is what we mean by one-sided being reflecting more of your belief in your position. The next thing the next step is to select the appropriate test statistics. In selecting the appropriate test statistics, I won't dwell so much on it. There are 5 tests that you can do. There is a test of a single mean, test of differences in mean, test of means of difference, test of a single variance, and test of difference in variance. The first thing you will notice here is that when you look at all of the tests, it is either based on mean or variance. And that's what I mentioned earlier, that hypothesis testing is all about mean or variance. So you see, it's either you are testing for a single mean or differences in mean, or you are testing for a variance or differences in variance. So all your test is based on the mean or a variance. Now, the statistics you use, there are 3 key statistics that can be used. We have the t statistics, we have the chi-square, and we have the f-square. And so each of these statistics has their own table. The t statistic has the t distributed table, the chi-square has the chi-square distributed table, and then the f-square statistic has the f distributed table. So that's just it on hypothesis testing. You would go through all this detail and select the right hypothesis. The next is to select your level of significance, how correct you want to be. Now, in selecting your level of significance, there are 2 types of errors that might occur. We have the type 1 error, or you have the type 2 error. And really, these are just very simple when you think about it. There are 2 types of decision you can make, and there are 2 situations that can occur. 2 decision, which means fail to reject or reject, right? And what do we mean by fail to reject? In statistics or in quantitative methods, we don't use accept. We say fail to reject. Fail to reject also means accept, but we don't use accept. You say fail to reject, and then or you reject. Your HO is your null hypothesis. Now, if you fail to reject your null hypothesis and your null hypothesis is correct, then you have made the right decision. So the decision is fail to reject. The situation is that your null hypothesis is correct, then that's the correct decision. If you fail to reject the null hypothesis and the null hypothesis is wrong, which means your null hypothesis is false, then you have made a type 2 error. If you reject your null hypothesis and your null hypothesis is correct, then you have made a type 1 error. If you reject your null hypothesis and your null hypothesis is false, then you have made the correct decision. So there is a type 1 error, which is the error you make when you reject a true null hypothesis, or a type 2 error when you fail to reject a false null hypothesis. So the level of significance is set. Typically, level of significance is set at 5%, which means the level of significance is a mirror image or the reverse of what we call the confidence level. Your level of significance determines your confidence level. So if I want to be 95% confident, right, then I will set my level of significance at 5. If I want to be 99% confident, then I will set my level of significance at 1. If I want to be 90% confident, then I will set my level of significance at 10. So that is the relationship between level of significance and then confidence level. The other part of the other steps will be dealt in detail in the class. But again, I just want to stop here and perhaps give more room for question and maybe look at one or two questions. These are not stuff to to rush through. Perhaps just to give you an overview of what you're looking at. And in my own my thinking is this, right? If you understand what each of the module is trying to do and how they are foundational to what you're trying to learn, I think it helps. But also, as much as possible, ensure that you're grounded here. So spend some time in actually studying this and start from here. After you are done with this, you can then go to the other modules or go to the other part of the curriculum and study them. But ensure that you have a firm grasp of all the things we've discussed here before you go to the other modules. And so perhaps we can just look at one or two questions now in areas where you want us to focus on, and then we can then take it forward from there. Do we have any question, or do we have a direction you want us to face in terms of questions, in terms of where to these questions from? We looked at about about 4 modules now, so depending on where you want us to focus on. Okay, so I can see here time value of money. Yeah, I mean, well, some of us use this during our project, but in those days, there are some guys that will tell you that they can interpret results for you, and you will see them as genius, because we're wondering that how are they making sense of all of this, all of these numbers, and they will run it, maybe SPSS and all of that, throw up some numbers. But the good news is, by the time you're done with QM, you too can run analysis for people, because all of the numbers that are generated, all of those numbers, you will see it, you will know what they mean, and you will know how to interpret it. As a matter of fact, they are really not that tough or difficult. So, just sit tight. By the time you're done with in fact, as you start studying your Q1, your level 1, you will start seeing a lot of the things you do at work will make sense. A lot of the things you've learned in school will make sense. CFA is that practical, that useful. So we'll take some questions. We'll look at some questions in time value of money. Okay. Also, there's a suggestion that we pick questions from each of the modules. Okay, so fine, we can look at that. Okay, so let's start with the time value of money. This time around, I will just use the curriculum and look at the questions in the curriculum. Now, let me use this question to, can you see my screen? Let me use this question to explain, to explain a concept I had mentioned earlier on compounding, the power of compounding. A lot of us, we hear this power of compounding, we talk about it, but what do we mean? How do we generate compounding? Now, so let's look at this question or this example. Now, the original investment here is $100, right? And the return is 5%, which means the interest rate for the first period is 5% times 100, and then that gives you $5. The interest rate in the second year, right, on the original investment is also 5, because the principal is the same and the rate is the same. So that's another $5. But in the second year, the interest for the second year based on the interest earned in the first year. Remember that in the first year you earn $5, you earn this $5, right? So it is assumed that in year 2, you now invest that $5 plus your initial $100. So you invested your initial $100 in period 1, you got your return of 5. Now in year 2, you are now investing your $100 again for the next period, and then in reinvesting the 5 that you got at the end of year 1, right? So the return you will get on the $100 face value is still the 5. Then the return you will get on the 5 is the 0.25. Now, the $5 you generated on the $100 is called your simple interest. Now, the 0.25 you generate on the 5 is called the compound interest, and that is where compounding comes from. That's where compounding comes from. What this means is that if you were to calculate this on a straight line, what you would then end up with is you might think that, oh, if I just if it's 5%, I will just do 5% every year on my principal and I'll get it. But because of compounding, you're not going to end up with that straight line. You're actually going to end up with something quite exponential, which is the power of compounding, because the more return you generate, those return will also start earning return on their own, and that returns they are generating will make your principal to become bigger and bigger and bigger with time. So even though you started with $100, you will end up your reinvestment per period will no longer be $100. It will be $100 plus all of the interest you have accrued over the period, giving you a higher principal and a higher return technically at the end of the period. So just to explain that. Let me see what question we can do. So let's see if we can look at some questions on even cash flow. I know we did. I know we talked about all of the other annual. We talked about the compounding, but the part where we may not have talked to, it's about cash flows. We talked about annuity. And like I said earlier, I brought all of this out from here. So let's look at this unequal cash flow. Let's see if we can deal a question on unequal cash flow. Let's use this one. Let's use Exhibit 5 just to explain that. Now, what do we mean by unequal cash flow? Remember this. When you're talking about annuity, there are two things to recognize an annuity, and I mentioned it earlier. The cash flow is the same. The periodicity is the same. Now, the moment the cash flow is not the same or the periodicity is not the same, then you are not dealing with an annuity. Therefore, you can't just use formula to calculate. So all those formulas that we've given is conditional on the fact that you're dealing with a cash flow or with an annuity. Now, if you're not dealing with an annuity, you're dealing with unequal cash flow, then you have to do each one separately. And so this particular question enables us to do that. Now, so these are the cash flows, and I'm highlighting them now. Under the cash flow, we have 1,000 in year 1, 2,000 in year 2, 4,000 in year 3, 5,000 in year 4, 6,000 in year 5. What you will notice here is that these cash flows are unequal, right? Now, how do you then calculate the future value of this? You then need to calculate the future value of each of the cash flows and then add it. Now, let me put that in a different way. You are going to treat the cash flow as if you invested them separately. Then calculate their future value separately and then add it back. The reason why you can add it back at the end of the period is the cash flow is now indexed to the same period in the future. And as long as they are indexed to the same period, you can add it. You can do addition on it. So for the 1,000, you are going to invest it for a period of 4 years because there are 5 periods. So you get it in year 1, right? Then you are going to invest it for 4 years. That is why you see that it is 1 plus 0.5 raised to power 4. Now, what is the 1 plus 0.5? It is 1 plus R. Now, in the formula that we talked about earlier, we say that present value multiplied by 1 plus r raised to power n. And that is what we've seen here. Your present value is 1,000. 1 plus r is 1.05 because 0.5 is the interest, which is r, and n is 4, right? And when you calculate that, you get 1,200. You do that for each of the period. But remember that when you got your cash flow for year 2, you only have 3 periods left. That is why it is raised to power 3. When you get your cash flow for year 3, you only have 2 periods left. That is why it's raised to power 2. When you got your cash flow for year 4, you only have 1 period left. So it's raised to power 1. When you get your cash flow by year 5, you don't have any period left. So technically it's raised to power 0. Now you see where that anything raised to 0 is 1. You see that the value is still 6,000, which means the value will not change because anything raised to power 0 is 1. So which means it's going to be 6,000 times 1, and it's simply just going to give you 6,000. Now, the way to visualize this is this. If you make an investment and all that investment is supposed to be paid to you by December 2024, let's say you made that investment some years back, and you're going to receive that cash flow by next month, right? The cash flow, the final cash flow you receive in December, which is next month, will you have the opportunity to reinvest it? The answer is no, which means if you are paid 5,000, it's going to stay 5,000. The only one that will earn something is the one that you got last year, that you put in a fixed deposit, that is going to pay you in December. That one will earn interest from last year to this year. But the one that they are just paying you next month for the first time is not going to earn any interest. Therefore, the value is going to remain the same. That is why it's raised to power 0, and anything raised to power 0 is 1. And therefore, you see that one is 6. And so when you add all of that together, it's going to give you 19.1. So essentially, the takeaway from here is when you're dealing with unequal cash flows, you have to calculate each one separately and then sum it up. Let's take another question. I'm looking for... We've looked at... The reason why I'm not looking at these ones, or I'm skeptical about using this one, these questions really is because of the formula. I want you to get introduced to these formulas gradually. I don't want to just push you into these formulas. For example, when you look at this formula, for me, I will interpret it as present value annuity factor, depending on what I'm looking at. I know it's an ordinary annuity, but if you're dealing with an annuity due, it might be different. If you're dealing with present value or future value, is different. So if I pick anyone at random, the question is still in your mind that why are we picking this one? The other question is, oh, what is this? What is this formula? What is it about? So that's why I'm trying to look for a question that is not based on a heavy formula. So let's look at this question. Looking at this question, not necessarily to maybe solve it, but to use it to explain how to think about answering questions. There are a couple of things I mentioned during the course of this session. Let's see how we can maybe incorporate it into a question like this. So let's look at this. A German pension fund manager anticipates that benefits of 1 million per year must be paid to a retiree. Retirement will not occur until 10 years from now at time T10. Once benefit begins to be paid, they will extend until T39 for a total of 30 payments. What is the present value of the pension liability if the appropriate annual discount rate for the plan liabilities is 5% compounded annually? Now, this is a very good question. Now, the first question, the very first point I said you should look at when you come across this kind of question is to ask yourself, what is this question asking me? Right? So clearly we can see here that it's talking about a German pension fund, but it's saying that what is the present value of the pension liability? So clearly it's a present value question. It's asking you what is the value today. What is the value today? So whatever formula you're going to be using, you know the final formula is going to be PV formula, right? That is one. Then the second thing is, how do you then know which one to then use? What formula to use, how to apply it? Before you jump into applying any formula, you need to first of all break down the question. It says, you're going to be paying out 1 million per year, but the 1 million will not start until year 10. Now, this is where your time series, that time series becomes quite useful. You have to draw the line. So present value is asking you T0, which is today, because it's asking you what is the present value. Present value is always to today. But look, the benefit will not start until T10. So it means that there is a T10 where you have to start from and first go to and then find some calculation for the next 30 years. And when you have done that, you then find the present value to 0. So there is kind of a 2-level or 3-level calculation that you need to do, because you're not starting from 0. You're starting initially from 10. Retirement will start from 10. It is from year 10 that you start paying 1 million, right? And then you are going to pay that 1 million for 30 years, right? And then you find the present value, which means you're going to start paying 1 million from year 10. You have to find the future value of 1 million paid every year to year 30. Then how much would that be in year 30? Then you can then find the present value of that number to year 0. And that's what it means. If you start your retirement from year T0, the answer you will get will be very different, because like I explained, the annuity factors are different. So you can't just use T0. You have to use T10 to first of all calculate it forward and then find the present value back to year 0. So let's look at how they approached it. Now, this problem involves an annuity with the first payment at T10. From the perspective of T is equal to 9, we have an ordinary annuity with 30 payments. That is, from a T9 point of view, you will have an annuity for 30 years, which means there is an annuity built in. We can then compute the present value of this annuity with equation 11 and then look at it on a timeline. So you see, you first calculate an annuity from year T9 to T30, and then you find the present value from that year 30 back, or year 39 back to year 0. And that is what they've done. And so the first one is the annuity from year 10, which is calculated as 15. So all this formula is the present value of an annuity, right? And that gives 15 million. And then you find the present value of that 15 million. So you see, from year 9 to year 39, the present value is 15. Which means as at year 9, you have a present value of 15. You then find the present value of 15 back to year 0, right? And hopefully that's what they've done. And so you find the present value of 15 to year 9, and that gives you 9. Now, what I hope that this question has illustrated is when you get a question, there might be different steps embedded. But you first need to understand what the question is asking, right? And then break it down. The best way to go about it without any error is to draw your line. If the question says that the payment will not start until year 10, which means you have to draw your line and start your calculation from year 10 ab initio. Then you then first find what the annuity or what that amount will be into the future, right? And then you then find the present value to today. Hopefully, that process of calculating or finding it would be a little bit clear. Let's take a question on data. All the questions of data, they are not as tough as that of of time value of money or any other one. But again, we can still just look at time value of money. Oh, sorry, on data. So let's see. I think perhaps for data, let's look at the end of chapter question. We might just look at maybe one or two. again, maybe also to give you a feel of the questions or the type of questions that is asked. If you ask me, how do you go about your QM module? Spend some time on present value, time value of money. The next place you should spend time on is your is your is your sampling and estimation and hypothesis testing. There are other courses there later that are not part of this prerequisite. That's the second place you should spend time on. Now, the time you will spend on your probability, you are going to you don't read generally for probability. And there's a reason why I won't recommend you do so. Read specifically for it. That is, you look, you can choose any approach you want to, but the approach I would recommend that you use is first understand that basics of probability, especially what is probability, how to calculate the basic probability and all of that, just the basic stuff that we touched on. Then from there, look at the multiplication, stuff and all of that. Once you've done that, right, come back and then read up on probability distributions. Probability distribution is what links you to hypothesis testing. Now, when you have a good understanding or at least a basic understanding of probability distribution, you'll be able to understand the bit of hypothesis testing, right? Not like you want to understand hypothesis testing, but at least for it to build, you will understand that. Once you're done with that, you can go back and read all your permutation and combination and all of that. Questions on permutation and combination are typically standalone. Questions on odds and even probability are typically stand alone. What I mean is that you get questions that are specific there, you answer it and you move on. But the other areas in terms of building stuff for other part of the curriculum, that's why I said read the basics of probability, read distribution, then you can continue to your hypothesis testing and spend a bit of time on all of those sampling and estimation. Then you can then come back and read up all of the other part. For your data visualization and on data generally, um, if you spend enough time, good time in class, you should be able to cover that. If you attend class and you follow the class, you may not even need to read it anymore on your own. I think it's that detailed, is that simple to follow, although it is very large. But I think that's the way to go about it. Well, I think our time is spent. The last thing I would also recommend or advise you do really is studying for CFA level 1. Um, do not take it for granted. Level 2 and level 3 has some advantages, and one of it is because you would have covered some basic foundation in level 1. Therefore, level 1 tends to be perhaps the toughest, even though level 2 has the most heavy lifting, really. But level 1 tends to be tough because that is when you get exposed to all of these concepts. So my recommendation is, look, do your level 1 very well. Take your time, give your time enough time to read, attend your classes, and participate, and just immerse yourself in all of the classes. You would do well. It's not it's not that hard, it's not that difficult. And all of the concepts, especially in QM, that you might think it's out there, they can all be broken down. Trust me, when you are in QM class and we go through this in much more detail, you will see that they are not as tough as we probably looking at it. All right, I think I'm just going to stop here. Our time is already spent. Again, I just want to appreciate each and every one of you for giving me the opportunity to be part of your CFA journey, and I wish you all the very best. Sure, you're going to enjoy. I'm sure you're going to enjoy the ride, right? Okay. So I'll hand over to admin. Admin, you can take it over from here, or can close the class.
New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today.
Hello. Sorry, is the admin here with us, please? I just want to ask if these slides will be shared with us. Don't know if anyone can hear me.
Yeah, waiting too. I think the admin has not joined yet.
Okay, thank you.